Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. It's a Friday morning and we are coming up after a spectacular move yesterday. That is the talk of the town, and why not, right? I mean, we rarely see what we saw yesterday, but we did. We'll, of course, discuss markets, everything else as well. I'm Prashant. With me, my colleague Surabhi and Mangalam. Guys, hi, good morning.
Good morning, Prashant. You'll be celebrating Onam over this weekend. So, to all our viewers, we wish a very happy Onam. And Prashant, you'd like to say that in Malayalam?
It's wishing everyone all the happiness and joy of the Onasham Sagal.
Onasham Sagal.
Yes, that's basically.
Smooth. You got that
Onasham Sagal.
quite quickly, not bad. And I guess the market has been in festive mood already, right? It started with Ganesh Chaturthi. Now we're getting into Onam and looking at the way the bulls are charging ahead and what happened, I guess, yesterday in the second half.
Yeah.
It's festivities galore for sure.
A lot of food as well.
That's good. That's always good.
All right. Well, let's just quickly start with what happened yesterday, because it was amazing and crazy, and everything rolled into one at the same time. And I'll tell you why. I don't usually sort of look at, I start with the global stuff, but I think we have to start with what happened yesterday, because there was a massive short covering led squeeze, and it was worth 400 points from exactly 2 p.m. 2 p.m. the Nifty was at 25,000. And of course, I mean, at the day's highest point, we were at 25,450 or maybe a little higher than that. So it was a total of 400-point Nifty surge post 2 p.m. That's what we saw. And of course, I mean, similarly on the Nifty Bank, etc. as well, we saw large rallies. Huge jump in call option prices, and Mangalam will talk more about this as we go along. So what seems to have happened, and we'll sort of substantiate this with data, is that a lot of call writers, humongous amount of call writers, perhaps were trapped, and they had to cover in a hurry. We were last 2 days highlighting how the Nifty was sort of stalling at the 25,100 level. So Tuesday's high was 25,130. Wednesday's high was about 25,112. It was an important technical level as well, the 61.8% retracement of the full fall. And it took that out with the first 100-point surge, and then very, very quickly added another 200 points. And of course, the last 100 points came in the sort of between 245 and 315. And then, of course, markets cooled off a little bit. You look at this, the 25,200 call went from 1.5 rupees to 223 rupees. You had the 25,100 calls, which basically surged from 23 rupees to a high of 424 rupees. I mean, this is the level of activity that we saw. Social media is a buzz in terms of why this has happened. Are these large algos triggering moves and, in a way, deliberately stopping out smaller retail investors and retail traders, etc.? And that debate will continue. But this is, big game in that sense, and we don't see this often. So I just wanted to start with this. To be sure, from the day's highest point, the market did sell off, and we lost about not a full 100 points. The adjusted close was 25,390 or so. But about 70, 80 points were given up from the day's highest point. But quite incredible. Now, so just to sort of turn the clock back to the US session, S&P 3/4, Nasdaq 1% higher. The 10-year yield added 3 basis points, largely flat, nothing very much. We were at about 3.68. Dollar index, that saw a sharp cut to 0.6%. We're back at about 101.17. Oil prices under 70 2 days back. We are at about 72 once again. Gold prices, right? It was a risk-on move. Tech did well. Actually, all sectors, all S&P sectors ended in the green, yet gold continues to participate on the upside, right? So we basically went to about 2550. The next resistance at about 2600, technically speaking. So where does all of this leave us? Of course, new all-time highs for the Nifty. For the Nifty Bank, maybe we're still waiting. I'll get the levels. I'll put out the levels. So there's an ending diagonal pattern which gives us a level of about 25,450. We were almost there yesterday. Actually, you can argue and say that is the level from where the market sold off, and that would be perfectly true. Supports come in at 25,111. It was the retracement resistance that I was talking about, and of course, maybe it now acts as a bit of a support. Bank Nifty broke above the previous swing high. That was good to see. Now, the resistance here is 51,943. which is the 61.8% retracement of the fall from the all-time high. And support comes in at the 20-day moving average for the Nifty Bank, which is 51,106. I just want to say GIFT Nifty will come up on your screen. Not all days are going to be as spectacular. Actually, very few days will be spectacular as yesterday. But the open is once again indicative of a 60-odd point higher start. I mean, if the bulls can press the advantage home and bears are really out of breath and, I mean, out of the game after yesterday, absolutely a crushing move. I mean, how much more can they press the advantage here? That's the question. But keep those levels in mind. At about 25, 450, there is a bit of resistance which starts to appear. Surabhi.
Absolutely. It was phenomenal, just watching the market cruise higher and higher yesterday. Intraday, of course, 1,433 being the intraday high. Just to add on to some points in terms of global action, yesterday we had a rate cut from the ECB along expected lines, but it was a bit of a hawkish cut, interestingly. That's why in the currency market space, the euro actually moved higher versus the dollar, despite that rate cut coming in. A 25 basis points rate cut delivered. The deposit rate, that is now at 3.65. So why do I say it was a hawkish cut? Because the ECB chief, Christine Lagarde, she very clearly, while speaking to reporters who were asking her about the next move and whether there'll be another cut in October, she said very clearly that our path is not predetermined at all, giving a complete indication that the ECB is going to be data dependent and there's no promise of another cut come the next month. Let's talk about some of the flow numbers yesterday, which are very interesting, looking at this huge tidal wave of buying that we saw towards the latter half of day. Now, yesterday's number on the FI side is something you can't ignore. It's a large buy number, 7,695. Yes, you have all the block trade action, including Honasa, which is where the numbers get a little skewed. But even then, I mean, all things put together, this is large buying, whether you talk about block trade buying or actual secondary market buying. So that's something worth keeping in mind. And for a change, it was actually domestic institutions that were on the sell side, selling about 1,800 crores. Let's come to all the macro numbers, and actually all put together, they're not very bad because the inflation print has been more or less static. It's inched up a little, slightly higher than what the CNBC-TV18 poll was, and also higher than the previous month. So August CPI inflation coming in at 3.65. The trouble here continues to be food inflation. There's simply no let up. And within food also, vegetables are the real sore spot. Food inflation at 5.66% versus 5.42%. So month on month, that increase is continuing. And like I'm saying, vegetables is where the pinch really is. Double-digit numbers continuing for vegetable inflation, 10.71, which is substantially higher than the previous month's picture. Pulses, etc., they've cooled off, but vegetables are still hurting, like I said. And of course, the relief is that on the fuel, power and light side, that's where disinflation continues, which is why the headline number is not increasing. And the core CPI number, which is what, of course, economists track, that's also unchanged. So that's the good news on inflation. Let's come to IIP. Now, on IIP as well, the incremental news is positive because the July number is 4.8 versus 4.7% in the previous month. And some of the constituents that have really fired up, manufacturing and capital goods. The numbers there, the month-on-month growth is looking quite strong. 4.6% on manufacturing versus 3.2%. That was the previous month's number. And capital goods in this month, July, is up 12%. So those are the engines that have really fired through. In terms of stock-specific action, there's plenty to watch today, including, a big acquisition that Nazara, for instance, has done, or Patanjali, which Nimesh tells us could be in focus on the back of some block trades. But again, I'll also be looking out for Easy Trip. Remember, we've been discussing the stock and company for a while, and today is the day when the board is meeting to consider more acquisitions. So let's see, I'm sure there'll be plenty of individual stock action that will keep us glued to our screens and our seats. But I guess at the headline level, Mangalam, we need to see if this huge bull charge can continue or not.
Absolutely. When things are good, typically what happens is people hope for another day of a good move, largely so that you eliminate the possibility of the previous day being just about luck. So let's talk just about that itself. Yesterday, there were fireworks, no two ways about it, on the Nifty and the Nifty Bank in the second half of trade in particular. And there were three reasons that one can attribute that to. One, of course, you look at the short covering that took place on, weekly options expiry day on the Nifty itself. The second part is that the Nifty Bank, that was the one that led the charge. As soon as it moved above the 50-day moving average of 51,362, we saw a bigger move come by on the Nifty, and that led to the Nifty breaking above its, earlier resistance of close to around 25,150 as well. All these factors put together led to a big up move. And if you look at the open interest change as well on both the Nifty as well as the Nifty Bank, along with the way the mid-cap index performed, one of the foretellers of the way the market moves increasingly is the way the advance decline ratio moves as well. So towards the second half of trade yesterday, we did see widening of the gap between advances and declines. Open interest change, there you have it. The second half advances and declines widen, and the open interest change tells you that there was a lot of long positions being added on the Nifty, and at the same time, there was a lot of short covering that took place on the Nifty Bank as well. So those are a couple of factors that really played out. If you look at the way, the indices moved and what happened, now as we start the GIFT Nifty indicating a positive start, the most important thing to watch out for is that the earlier resistance, do they now become support? So watch out for the Nifty, seeing a support at 25,150. The support has now moved higher. And for the Nifty Bank, that number would be 51,400 itself. So the support for the Nifty has moved higher, as has for the Nifty Bank. Going forward, the two sectors I'll be tracking very closely would be the IT space and the metal space. Why is that? Because next week you have the US Fed meet, and typically ahead of that, these global facing counters do well. Overnight, Oracle actually surged about 6% on account of increasing their guidance as well. So those factors are things that we'll keep an eye out on in particular. Just watch out for the IT pack and the metals pack. The one stock that I'll keep an eye out on today is the stock that was the stock of the day yesterday on the downside, was Granules. After a big downtick, it's entered F&O ban. Let's see how this one moves out in today's trading session. So could there be an encore today? Perhaps yes, but at what levels do support comes in and what levels do resistances come in? Prashant has laid that out already.
All right, Mangalam, interesting day yesterday, right? And
Very.
Really adrenaline, pure, absolute surge is what we saw. Well, we'll talk more about that with our guests as we sort of take this forward. But I want to get you some views on global markets and macro markets as well. This is Christopher Wood of Jefferies, who writes his famed Greed and Fear note. He says that the US presidential debate on Tuesday night was important because it might be the only one. According to him, Kamala Harris clearly won it. She was well prepared while also successfully baiting the Donald on several occasions. He says greed and fear is therefore not surprised that the betting odds have moved in the Democrat candidate's favor. He adds that on the other side, this is presidential elections. The other, of course, is the Fed policy. A 25 basis point Fed rate cut next week remains the base case. He goes on to say that if in the near term, the focus of the market remains on monetary policy, and no doubt, and increasingly over the next 2 months on U.S. elections, greed and fear is still of the view that the biggest near-term risk to markets remains geopolitics. Chris says the conditions on the ground in Ukraine and West Asia remain as highly charged as ever. All right, well, that's Chris Wood with his perspective. Arindam Sanger is with us, managing partner at Geosphere Capital. Arvind, great to have you with us here. Thank you very much for your time. I don't know if you saw the move yesterday in India, Arvind. Just sort of mind-boggling. I suspect after the move yesterday, once again, the debate about what some of these sort of foreign large algo firms, etc., are doing here in the Indian market and what should be done, etc., will resurface in a big way. We had a 400-point move in 90 minutes. Just your thoughts, and if you saw yesterday's session, and where do we go from here?
Well, look, the market is working not on foreign algos or foreign money flows, it's working on domestic liquidity flows. Let's be clear what's driving the market. I'm not talking about day-to-day, hour-to-hour, but I'm talking structurally. So, we can just, sit back and watch with some awe and wonder, because the market is, clearly in pretty close to uncharted territory. You're seeing some pretty marginal IPOs coming, and then some good quality IPOs, but some marginal IPOs coming hugely oversubscribed. So this is, as I would say, the mother of all bull markets. And, while the party is going, I guess everybody's having fun. But keep in mind that no party lasts forever. But for now, I don't see any flaw as long as the world is throwing liquidity back into the economies with ECB cutting rates and now Fed poised to cut rates. And assuming we don't have any global economic accidents, India seems to be right now in a sweet spot.
Arvind, a lot on the street are also of the belief that maybe all of this is pricing in a Fed cut already. And once the Fed does go ahead and cut the rates, maybe that could indicate a near-term top. Are you in that camp?
Well, clearly, I think, the economies are slowing. Certainly in the US and in Europe, the economies are slow. China is clearly slow. And everything is now contingent on the liquidity coming from the Fed. I don't think the Fed has a magic wand to fix a slower economy. Maybe in 6 months it'll speed up the economy, but I don't disagree with the idea that markets have largely, not, you can never say fully, but have largely anticipated now that there's a Fed cut coming. So where can the positive surprises come from? The positive surprises can come from, there's some talk about China throwing more liquidity at the market, trying to accelerate mortgage reductions for homeowners in China, other measures to try to get the, what seems to be a downward spiral in the Chinese economy halted. So, other than that, if that turns and the Fed and ECB and others are throwing money and inflation remains under control, I think, markets may remain bid, but I don't know whether we can point to as strong a trajectory as India has, where liquidity certainly sees no signs of abatement.
Completely take that point, Arvind. Good morning. And I think a sign of that liquidity showed up in some of the recent IPOs. I want to go back to that point that you were making and look at what Bajaj Finance did, right? They asked for about 6,500 crores. The market is willing to give them over 3 lakh crores. I mean, that was the extent of the oversubscription. One understands pedigree and all of that and, a leadership position, etc. But still, it's just the numbers tell you the story here, right? So as this tidal wave of domestic liquidity continues to slosh around, what have you been doing? Have you participated in any of the new IPOs? And what's the advice? I mean, how to keep sane as this liquidity-driven party continues here?
Well, we are participating in the market appreciation with companies that we like. We have largely stayed away from the IPOs because, for the amount of money that you put up and for the allocations you get, and then the pop you get on the first day, it's a modest return, but, there are a lot of people who do that. We're not playing in that. So we're looking for opportunities where we can buy companies at reasonable valuations. And the reality is, if you get a little bit of the IPO on the IPO, it's reasonable, but it gets to unreasonable very quickly. So we're trying to be a little more value conscious, but in this market, value has long left the building, and all that's left is momentum. So it's one of those where we try to find wherever we can find elements of value, but this is a bull market which is the likes of which we have rarely seen. I think we'd have to go back to 2007 to find anything even comparable in terms of the amount of liquidity and euphoria. But we're trying to find a little bit of value in some sectors, but the reality is that IPOs is not the place where we've been playing, but there are quality companies that we're trying to play.
Got it. Absolutely. I'm just wondering, Prashant, he's talking about the sea of liquidity, and this is when the Fed hasn't even opened the tap. That's going to happen probably next week. And then I wonder what we'll be dealing with. I
mean, 18th, I think we'll get that cut. That's Wednesday. And for us, of course, it'll be Thursday morning. Next Thursday morning, we'll have...
on the IPO bit itself, you guys were talking about that. I see some data coming in from Hormaz. He says that in 2023, the money raised via IPOs was close to 49,400 crores. In 2024, so far, we're not even done with the year, and big IPOs lined up for the second half. We've already raised 62,650 crores via IPO. So the first half of this year so far, 50% more than what we've done last year.
Absolutely. Well, we'll talk about more stocks as we go along. So let's quickly get you a sneak peek. Nazara is going to be in focus. Muthoot Finance, Manappuram Finance. That gold surge, of course, powering those names. Tata Power, Intellect Design, and we'll also have Puravankara and PNB Housing Finance on our radar. On the green side, Patanjali Food, Honasa are stocks that are likely to open in the red. So our research team joins in with all of that in a bit from now.
Welcome back. So it's time to talk about individual stocks and plenty of them on the radar. So our team is standing by with the CNBC-TV18 list of top stocks to watch this morning. First up is Vivek. Vivek, you're watching out for Patanjali Foods this morning. Tell us why.
Well, good morning. That's right. So a block deal is expected in Patanjali Foods. We had access to the term sheet and we understand the two promoter entities, that is Patanjali Ayurved as well as Patanjali Parivahan, both of them are together will be selling close to 3.1% of the total equity. The floor price for this particular block deal is at 1,815 rupees a share, and there is a 90-day lockup on further sale of shares. Remember, the promoter and the promoter entities held close to 73.8% stake at the end of Q1. Expect some weakness in the stock today on the back of this particular supply that will come in.
All right, that stock lower on the supply that is likely to come in. But Rima joins in, the big acquisition from Nazara Tech, a near 1,000 crore one. Rima.
Thanks so much for that. Indeed. So Nazara has announced that they will be investing 982 crore rupees in a company called Moonshine Technology, which owns PokerBaazi, which is one of India's leading poker gaming platform. Now, this 982 crore is structured as following. The company will be investing 150 crore into the company. So this is growth primary capital which goes into the company, which Nazara will do via convertible preferential shares. The balance will be done via cash infusion plus a share swap. So that's how the transaction is structured. But this is a large acquisition because the acquired company had revenues of approximately 400 crore in FY24. And to put it in context, Nazara's FY24 revenues were close to about 1,100 crore rupees. So we're talking about a company which they've acquired is 40% of their current size. Margins of the acquired company are also close to about 10% at the EBITDA level.
All right. And by the way, we'll be speaking with the management of Nazara at 9:40 this morning. So that's going to be an interesting conversation to have. Stock, of course, has been doing well over the last couple of days, 1,008. Well, let's talk about gold finance companies, Muthoot and Manappuram. Abhishek is here to tell us why they're in focus. Abhishek, morning.
They are in focus because gold price is at all-time high, or they are shining really well. So it's now at $2,563 per ounce. If you take a look at the gold prices, in last 1 week, they are up 2.5%. In last 1 month, they are up 7.5%. While in last 3 months, they are up 18.4%. And in last 1 year, they are up more than 33% on a YY basis. This augurs really well for gold finances like Muthoot and Manappuram. Remember that in Q1 FY25, Muthoot Finance had their gold AUM grow by 11% quarter-on-quarter, while Manappuram, on the other hand, had their gold AUM grow by almost 10% quarter-on-quarter. For Muthoot, gold financing forms about 98-99% of the AUM, and for Manappuram, it's around the 50-55% level. Also, the fact that IFL Finance still is absent from the gold financing market, which augurs well for these two entities, given the fact that they'll be able to disburse more loans to customers. Back to you.
Okay, all right, got that, Abhishek. Thank you very much for that. Let's go across to Vamakshi. She's watching out for a couple of stocks as well. Vamakshi, good morning.
Well, good morning, Surbhi. Let me first start off with Tata Power. The company's step-down subsidiary, Tata Power EV Charging Solutions, has signed an MOU with Tata Motors. They will be setting up 200 fast-charging stations for electric CVs in 5 metros. So given that development, going with the green for Tata Power. Intellect Design is the next one I'm watching out for, and that is because the company has launched eMAC.ai for financial landscape of Sri Lanka. Keep in mind that the company already works with several notable financial institutions like HDFC Bank Sri Lanka, RDB, Cargill's Bank, among several others. And with this new launch, the company is poised to strengthen its partnership with not only these banks but several other financial institutions in Sri Lanka. Apart from that, BLS International has signed a definitive agreement to acquire 100% stake in Citizenship Invest for $31 million, or roughly around 260 crores. Keep in mind that CI is a Dubai-based advisory firm, and this acquisition will be funded through internal accruals and is expected to be completed by October 31st, 2024. 2024. So given that development, going with the green for BLS International. And lastly, let's also watch out for Puravankara. Several announcements out here. Firstly, the company has acquired redevelopment rights for Miami apartments located in Breach Candy, South Mumbai. This site spans over 2,000 square meters and the current rates in this area are estimated between 1.25 to 1.4 lakh per square feet. And with this, the company has entered the high-end South Mumbai real estate market. Apart from that, they've also been selected as a preferred developer by a cluster of 4 societies with land measuring nearly 1.3 acres in Lokhandwala, Andheri West. And lastly, they've signed a joint development agreement for nearly 2-acre land parcel in Bengaluru with a saleable area of 2.6 lakh square feet. So overall, going with the green for Puravankara as well.
All right, green with the Puravankara, buying land in Breach Candy, Lokhandwala as well as Bengaluru. Well, we started with Vivek on, a block deal that is likely to happen today. Let's go back to Vivek on the details of the block deals that happened yesterday. Vivek.
Well, that's right. Yesterday did see 2 quite large block deals happen. Remember, earlier yesterday morning, we told you about how Nazara Consumer, you actually saw the block deal size get upsized to a little over 10% of the total equity. So along expected lines, the sellers, private equity investors, who've been around even from the pre-IPO days, they were the sellers. So Peak 15 Partners, Sequoia Capital, Redwood Fund, Fireside, Stellaris, as well as Sofina Ventures. All of these entities, remember, held more than 30% stake at the end of Q1. They were the sellers. Amongst the buyers, you did see names like Morgan Stanley Asia, ICICI Prudential Life Insurance. They were the ones who actually bought the stake in yesterday's block deal. Now, the other company on the radar is PNB Housing Finance. Again, yesterday a block deal over here. Asia Opportunities Mauritius Fund sold close to 16.2 lakh shares, a little less than 1%. Remember, at the end of Q1, they held over 5% stake in the company. Amongst the buyers, Government of Singapore picked up a significant chunk. So almost 13 lakh shares was picked up by Government of Singapore. Other buyers included Goldman Sachs as well as the Monetary Authority of Singapore. Going with red on both of these claims, PNB Housing expects some recovery after, if there is a dip in the session today.
Okay, all right, got that. Vivek, thanks very much. Let's quickly recap our list of top stocks to watch this Friday morning. The ones that have positive news flow around them are Nazara Technologies, Muthoot Finance, Manappuram Finance, Tata Power, Intellect Design Arena, BLS International, Puravankara, and PNB Housing Finance. Stocks with negative news flow around them, Patanjali Foods and Honasa Consumer. All right, that's our stock list for the morning. Let's figure out what's happening in the world of commodities. Manisha is joining in with a roundup of all the action. Manisha, good morning. We have to start with the sparkle on gold. It's all kinds of records ahead, I guess. Tell us more.
Well, absolutely. What a run-up in the overnight markets there. Everything went well for the gold prices. To begin with, you had U.S. inflation, which continues to ease overall. The U.S. unemployment claims saw a rise, and now there's an 87% probability of a 25 basis point rate cut in the next week, and a 13% small probability of a 50 basis point rate cut. So with overnight gains of 2%, we are holding around $25-60 an ounce, which is an all-time high. We started this year with around 2,000, so it has been a strong jump up in case of gold. But not just that, it was 4% of gains for silver, platinum, palladium, steel, copper, aluminum, zinc. All of these metals also have seen some gains, and this is after the US dollar index saw a bit of a decline. The ECB rate cut has seen a rate cut, and the markets are now anticipating that next week, it's not just the US markets, but Bank of Japan, Bank of England monetary policy meetings are also coming up, and expectations of rate cuts from that as well is what is supporting across in sense of commodities. And a last word on crude oil prices. Remember, we started this week with a lot of sharp decline, but on a weekly basis and with the kind of gain that we've seen in crude oil prices in the last 2 days, we are headed for a weekly gain of almost 2% for crude as well. So across commodities, it's a very, very strong start to Asia yet again today.
All right. Thanks very much, Manisha, for that. So 2% bounce. Under 70 for a brief bit, but back at about 72 now. More later, but some crucial macroeconomic data also has come in. Inflation has risen marginally in August as food prices remain stubborn. On the other hand, industrial production picked up in the month of July, growing at 4.8%. Lata is here with more. Lata.
Yes, the key takeaway is that the August inflation, which came in at 3.65, is well above the CNBC-TV18 poll of 3.42. Actually, it's not just 25 basis points more than the poll. The market had run away with the expectations that even this 3.4, 3.45 that the polls were showing are an overestimation. And the CPI will undershoot. So for the market, it's a very big disappointment. It's about 30 basis more than what people were prepared for. And in the run-up to the inflation number, from Monday to Wednesday, the bond yields had fallen from 6.85 to 6.80 when we closed on Thursday. So now that much ground will be, will have to be covered, and I would expect that yields will rise a bit. The biggest culprit actually is food. The point is not that food is higher, it has not fallen enough. That's the worry. Food inflation overall came in at 5.66 versus 5.4. In the month of July, it was expected to come much lower at something like 4.5%. And within food, it is cereals perhaps which has disappointed the market more. Cereals were expected to fall month on month, and it has actually risen by 0.6. So now people will start worrying, once you have a higher than expected number, worries can pick up that, there are going to be October rains because of La Nina impact. That can reduce the crop further. These things can get a life of their own, especially because global commodities are higher now. Crude, which was well below 70, is now $72. So, all these expectations that a small chance the Reserve Bank will change its stance in October goes out of the window now. And therefore, to that extent, the bond yields will have to correct. And let me remind you, that will be bank positive, because a lot of bank loans are linked to T-bills, are linked to some market instruments, and therefore if the yield goes up, this could be actually seen as bank positive. A word on the IIP number, it's come in a little higher than expected. Our poll was 4.3, it's come in at 4.8%. What's even better, the June IIP number, last month's, the previous month number, has been upped from 4.2 to 4.7. So two good numbers, 4.7 and 4.8. Within that, CapEx has shot up to 12% for the month of July. April, May, June, every month was, around 3%. Obviously, the government was not spending during election months, and now it's come back with a vengeance, positive. What's negative is consumer non-durables. Consumer durables is doing fine. Non-durables is minus 4.4 for July. And if you take April, May, June, July, then it's minus 1.5. So all this talk of rural recovery and urban consumption maintaining at least, there's a bit of a cold water thrown on that enthusiasm.
Okay, all right. Lata, thanks very much for giving us that perspective. We'll keep those numbers in mind. Take a short break right now. Up next, we connect with Siddharth Khemka of Motilal Oswal Financial Services and get some fundamental stock ideas going.
Welcome back. You're watching us here on Bazaar Morning Call. The GIFT Nifty is suggesting a positive start after a fireworks sort of day in yesterday's trading session. The GIFT Nifty implied open has improved from about 35 points when we started the show to about 76 points as well. So let's talk about individual stocks. Now, one of the latest D Street debutants, Interarch Building Products, their numbers came by. This is the first quarter numbers. Remember, the company listed towards the end of last month. Revenues and profits contracted quarter on quarter because of seasonality. Arvind Nanda, who's the MD at the company, joins us now. Thanks a lot, Arvind, for joining in. You know, the first quarter numbers, of course, seem dated now because of the weakness in execution, because of elections, etc. Now we're towards the end of the second quarter. Can you tell us how the second quarter panned out? And in light of that, what's the guidance that you have for this entire year when it comes to order inflows, revenues, and margins?
Thank you very much for having me on the show. Our business is such that we are more on a half-yearly basis rather than a quarterly basis, which the market demands. Because, like you mentioned correctly, elections and then monsoon and heat waves at different points, because depending where we are executing orders for customers, so it can vary. Last year, the first quarter was better than the second quarter for various reasons. This time, because of elections and not availability of sites as easy as last year. So first quarter is a little lesser, even though it's still an improvement over last year. So we are very happy with the results, because in spite of everything, we have managed to achieve a higher turnover and a higher profit than the last June quarter of 23. So we are very excited and in the company that we have managed to achieve that, because we were very pessimistic when the elections were going on about clearances. The second quarter is going to be better for us in this year. Unlike last year, the second quarter was a dip compared to the first quarter. But this year, the second quarter is going to be, I would say, much better. Like you rightly said, we are well into the second quarter. And end of the year, our projections already given.
Okay, Mr. Nanda, so let's just get some more details in, because I believe you've inaugurated, a new capacity at Andhra. And the earlier conversation that we had with you, the indication given was that at peak capacity, you can do a revenue of about 550 crores. So can you just tell us what are the timelines of scale up? Now, what is your total capacity? Where will it be by the end of FY25? And in light of that, what's the kind of top line growth in 25 and then 26 that you can project with the capacity addition?
Yes, each fully integrated plant gives us about 550 crores. So we already have 3 fully integrated plants. So that's a capacity of 1550 to 1600 crores compared to our turnover of 1300 in March. So we have capacity enough to achieve our target for 24-25. The new plant in Andhra, which we inaugurated last week, first phase. Second phase will also be done. So first phase adds approximately 100 to 150 crores to our capacity for the balance of this year. And the full plant, once it's finished in February, March, will add another 550 crores. So for 25-26, we will have approximately 2,200 crores of capacity at current prices of steel. That is the capacity we have got. And our projections given for the following year, 24-25 and 25-26, 26-27 as well. We are well on our target to achieve these our targets with these capacity that we've already built. As also mentioned in DRHP, we have also got a land tied up in Gujarat now, which we hope to start as soon as we see a order pickup. Plan is next year, June, July starting. But I think the way we are seeing the orders come in and the demand from bigger customers and major projects coming up, I think we'll have to start it sooner and build up that also, so that we can remain well on track, as we said earlier, to double our turnover in about 3.5 years.
Double your turnover in about 3.5 years. Just for the benefit of our viewers, if you could repeat the guidance that you had given for the end of this year on the revenue front, because FY26 you've already said 2,200 odd crores. Are we looking at numbers around 16 to 1,700 crores in FY25? Is that a possibility?
No, we are looking at our guidance was about 15% increase over the current year, which is 24 was 1,300 crores approximately. So we are hoping that we should do about 1,450 to 1,500 in the 25 in the coming year. Because, in pre-engineered buildings, you have to also build up capacities for a lot of other things just in your plant, engineering, sales, execution. So we are well on our target to achieve that objective, and then maybe another 20% for 25-26.
Got it. 1,400 to 1,500 crores for this year and another 15-20% for the next year. On order books, at the end of the last fiscal, your order book stood at around 1150 crores. And at the end of the first quarter, it stood at around 1350 crores. So X of execution, one can assume that order inflows were close to around 200 odd crores. In the second quarter so far, what has been your order inflow? And what's your target for order inflow for the remainder of this year?
We have, our target is 1350 crores. We have achieved already for this year to turn into orders, because our pre-engineered building order book is not very long. Most customers, even for a very large order, would not order about a year before they need the building. So, it's not 1350 crores is a very good order book for our business. In fact, we can't take any more orders because we will not be able to execute them as per customers' requirement. So I think order book is well in track. This year, till today, we have already achieved, we have unexecuted orders of 1350. We are hoping that we will take another 300 to 400 crores of orders in the coming year, as orders are not a problem. It's what we can take and what we can execute, because for Interarch, the commitment to execute is very critical. Our customers rely on us to give them, correct delivery and on-time delivery, because they have their whole project depending on us.
Sure. All right, sir. We'll leave it on that note for today. Thank you for joining in with that quick take on how the business is shaping up. Let's now head back towards the market and see what we can expect after what was a bumper Thursday. Anuj is joining in with the trading setup. Anuj, good morning. So what do you make of things after yesterday's big surge?
Yeah, morning, Surabhi. You know what, yesterday's trade reminds me of the song. You may not have heard of it. Mangala, I'm sure, would have. Aakhir tumhe aana hai, zara der lagegi. It's like, FIS coming back in the market, and how 7,000 crores of buying in cash market. But, make no mistake, some of it was a pure expiry related play, because you did see not just a small squeeze, a massive squeeze in the call positions. I'll just give you two strikes, 25,200 and 25,300 calls. And look at the moves from 1.5 rupees to 223 rupees and from 25 paisa to 123 rupees. So you did buy 7,000 crores in cash, but you did make a lot of money in the options. Of course, the other big question is, was it just an options game, or was this also because of the rate cuts? You have the ECB rate cut, next week perhaps the Fed rate cut. So some money already moving to the risky assets or supposed risky assets like commodities, like emerging markets. That could be a possibility, because after ECB, the focus will shift to Fed. The bank Nifty is 3% away from all-time high, so that's something to focus on. Yesterday's move could be a pointer towards filling that gap between Nifty and Bank Nifty. Coming to levels then, the Nifty, of course, is trading in blue sky territory. So the next resistance is purely on options, 25,500, which is where the monthly options data is placed. And then, of course, you have 25,800 to 26,000. The support comes in at 25,100 to 25,200 first, and then 24,950 to 25,050. On the Bank Nifty had an 800-point rally yesterday. Let's move on to the resistances. The next resistance is 52,000, and the bigger resistance is 52,500. The first support would come at 51,500, and then the support comes in at 51,000. Let's come to the quote of the day. And this one would come up for you on the screen. Happiness isn't a goal, it's a byproduct of a life well lived. So enjoy your Friday and have a good weekend.
Enjoy our Friday and have a good weekend. Great quote, Anuj. But, you did whet our appetite by teasing a song. And it's a Friday. I can't let you go without singing a line or two of the song that you just mentioned, Aakhir Tumhe Aana Hai.
Mangalam, let's leave it for another day. And, as I said, Surabhi, you may not know the song.
No, I do know the song. I don't know all the lyrics, but, well, yes, now that you mentioned it, yes, it's a classic. Yeah,
it's a classic. But, my singing ability, Mangalam, it's quite poor. So I would just keep it here.
Well,
all right, Anuj, thank you. Thank you so much for that and for the inspirational quote. As always, you have a good day as well. We'll, of course, get back to the conversation with Siddharth Khemka, Head of Research at Motilal Oswal Financial Services. Siddharth, thanks so much for joining in. Lots of stocks to discuss. Let's start with what else, but the gold financiers, typically when there is such a flare around gold prices, these stocks come back in focus. But you tell us, of course, they've managed to weather quite a few of the regulatory changes as well. Manappuram Muthoot Would you be a buyer at these levels? What's the view?
Yeah, hi Surbhi. Good morning. Glad to be on the show. So yes, I think whenever the gold prices moves up, there is a lot of interest not only in the gold jewelry companies but also some of these gold financiers, and some of them after a week, you can say numbers have started showing some improvement, especially if you look at they've also diversified their book not only into microfinance, but some have also got into the housing finance space, and that helps them build a stronger book. So between the two, Manappuram and Muthoot, currently we have a neutral rating on Muthoot and a buy rating on Manappuram. We believe growth in current year may not be that strong for Manappuram. So for FY25, our growth estimates, net profit growth estimates for Manappuram is around 10%. But we believe next year things would start looking up much better, and we are forecasting a 24% earnings growth. Valuation-wise also, Manappuram is better placed. What we see in the current environment is a lot of NBFCs would start doing well with the interest rate cut cycle starting to happen, and some of these stocks, for example, Chola, which is our preferred pick within the NBFC space, continues to do well, although it trades at a premium valuation with a steady growth. We continue to like something like a Chola, where we believe that the company would continue to grow both its AUM and with the help of the credit cost coming down, leading to a strong return ratios, ROEs in excess of 20%. So that continues to be our preferred pick. Another stock, which is your L&T Finance holding, which we believe could do well in the current environment, especially if you look at the company has put out a new strategy, which is your Lakshya 2026, and that is looking to reduce its wholesale lending segment and diversify into some of the other segments which are not only high yielding but also high growth. Again, valuations are comfortable for L&T Finance, which is also where we have a buy rating and a steep upside, almost 30-40% upside from current levels with a target price of 230.
Well, among the stocks, the few stocks that were under pressure in yesterday's trading session, Siddharth, were the pharmaceutical pack. We have Biocon, which was down by about 2.5%. Kiran Mazumdar-Shaw did tell CNBC-TV18 that she's not looking to sell out, this business. She's a founder. And Granules was the other one. Major observations coming in for their Gagillapur facility. They haven't, been immune to US FDA sort of issues in the past, but they've come out successfully. Do you think of this decline as a reason to buy? What are your thoughts on both Biocon and Granules?
Yeah, hi Mangalam. So I think in case of Biocon, clearly the street was excited with the news of the stake sale, and the denial led to some people who had bought the stock in anticipation of a news flow regarding the sale would have exited. But I think the core business continues to do well. In the same interview, the management also said about coming out with the IPO for Biocon Biologics, which would be also another trigger going forward. So clearly, in case of Biocon, I would remain positive, and the decline is only sentimental decline, and hence definitely an entry opportunity. In case of Granules, what we see is that the observations are relating to very core or basics, for example, cleaning, maintenance, inadequate root cause analysis, some document issues and procedures. So these are issues which, as you rightly highlighted, can be resolved easily. They are not life-threatening issues with regards to some issue with the chemicals or the compounds itself. So while in the near term there could remain under pressure for 1 or 2 more months, but we believe these are procedural issues and can be resolved. Hence, again, if someone is looking from a 1 or 2 month perspective, I would remain on the sidelines. But over the next 2-3 months, the pressure in the stock, definitely we would see that it is an entry opportunity. We continue to have a long-term positive view on Granules with a buy rating.
Okay, so not for the faint-hearted and definitely not for those who are looking at the short term. That's the word on Granules. Siddharth, got it. Stay on with us. We'll come back with some more questions. And also after the break, we get chatting with our technical experts. Samitesh Thakkar and Shrikant Chauhan join in with some trading ideas for the day.
Welcome back. We've got Mitesh Thakkar and Shrikant Chauhan who are with us with what they'd want you to do in terms of specific trading ideas. Gentlemen, great to have both of you here. And Mitesh, we spoke at about 3:10, right? I think yesterday with the market was doing what it was doing. Just an incredible sort of a day. So what exactly is the advice now after the surge and what's really happened on the option side? Do you think bulls can push advantage further from here? Where do resistances come in, if there is one? Go on.
Morning, Prashant. Yesterday, I was highlighting that it could be the Bank Nifty 1, which is showing signs of covering for its underperformance, and that could propel the Nifty higher. I think both the Nifty and the Bank Nifty did well. And my sense is that kind of movement might continue for next few days. Now, looking at the targets, I think Anuj was highlighting 25,500, which is where the options open interest is on the higher side. I've been looking at that level as well. So that remains one target. And if you look at the extension possibilities, then we might get a target of 25,650, 700. So I think we'll work with two targets on the upside. But having said that, I would still want to keep some focus on the financial names and the banking pack. I think that's where a strong action could happen, particularly the private sector lot, which has really underperformed the broader markets for many months now. I think they are now showing signs of some kind of reversal, and they would cover up for their underperformance as well. So yesterday we had HDFC Bank, today we have Axis Bank. So broadly, keep a long stance, but focus more on the finance side.
All right, long stance with a focus on the finance side. Shrikant, your thoughts on the indices?
Yeah, good morning, Mangalam. Good morning, everyone. I think, the way the market has had formed this 25,350 classic top, it was completely not expected yesterday that the market can cross this level so easily. But by crossing this important level, now I'm of the view that the way there is participation from all these large cap companies, there are fair chances that the market can hit the levels of 26,000 in next few days or few weeks. So the new run-up has started and we are heading towards the levels of 26,000. That's the overall view. In case if there is any correction because of any reason, then close to the previous highest level, that is around 25,300, 250 levels, there we should look for taking some long bets in this market. Otherwise, I'm of the view that broad-based activity we are going to see in the near term, and especially large cap companies going to participate in this up.
Okay, all right, gentlemen. Morning to both of you. So we've got the index calls out of the way. Let's talk about individual stock action and stock calls. Mitesh, what will you go with today?
Good morning, Sulbi. Two stocks, are from the finance side. Axis Bank is a buy. Keep a stop below 1189. Look for targets of 1235. And Chola Finance, in fact, in the last couple of weeks, I've given a buy call many times over here. Yesterday was a gap up opening, and then the stock showed continuation. So this should possibly head towards 1640, 1645 range. And this is a buy with a stop below 1542. The ACC is a buy as well. Keep a stop at 2422, just below yesterday's low, and look for targets of 2550. And a buy on Aditya Birla Fashions with a stop at 319.5 for a target of 340.
Okay, all right. Got that, Mitesh. Thanks for the list. Shrikant, what about you? What stocks today?
Yeah, good morning, Sulbi. See, from the technology basket, we like HCL Technologies. And here also, if we see the technical pattern, then it has crossed its previous swing highest level. And now it is comfortably trading and sustaining above the level of 1750, 1770 since last so many days. So based on its technical formation, I think it is heading for at least 1900, 1950. It's a buy at current levels with a stop loss close to 1750. The other stock on which we are bullish is from the metal baskets, and that is Vedanta, which is around 440, 441. From here, the stock can again move back to the levels of 450, 455. And for that also, we can keep a stop loss somewhere close to 434. But we also like HDFC Bank, where it is forming some rounding bottom sort of formation. It will take some time, but I think eventually the stock is heading for the levels of 1800. So broadly, if we see the market and index heavyweights, then I think there is a lot of correlation. And based on that, we can see further more activity in large cap companies.
All right, a lot more activity in large cap companies. Both Mitesh as well as some, Shrikant are talking about the financials, liking the large cap financials as well. We take a short break, come back on the other side. We'll get you the pre-opening rates. Also with us will be Aditya Khemka of InCred Healthcare Portfolio PMS to focus on the pharmaceutical sector, which was sector of the day on the downside yesterday.
Welcome back. So the first of the pre-open rates have started coming in, and the suggestion is that we will at least, kick off the day on the green side once again. In the pre-open, early trends, of course, right now, Nifty is looking like it could be 30, 40 points higher. Well, as those rates settle down, let's go across to Avni Bhatt, Senior Vice President, Equity Derivatives Research at JM Financial, to get a couple of F&O trading ideas as well. Avni, good to have you on. So what strategies will you work with today?
Good morning, Surbhi, and thank you for having me on the show. See, my expectation is on Nifty, I think 25,450 to 25,500 region is a very strong resistance as far as the option writing bets are concerned. And that's why I would suggest not to go chasing the gap up opening. We could probably see some profit booking by end of the day. That is the point where one should take some profits off the table. And as far as index is concerned, having a stock specific approach would be more wise. Now going for the stocks, my first bet would be Tata Communication. A nice bullish engulfing pattern formed on the daily charts and backed by good volumes and open interest addition in futures. So Tata Communication is a good buy at current levels for a target of 2120 and a stop loss of 1975. The second counter is ACC, the rounding bottom formation on daily charts and short covering CNN futures to an extent of 2%. Unwinding CNN calls and put writing addition has also picked up. So that makes it a perfect candidate to go long for a target of 2600 and 2680, keeping a stop loss of 2400. And the last counter that I would go for is the index heavyweight Reliance. So Reliance can be a good buy at current levels. It has bottomed out and it can move up to for targets of 3080 and 3120 on the upside, keeping a stop loss of 2885.
Avni, the call writers yesterday, right? Is there any way to estimate the extent of the damage / losses? I mean, it just was crazy. I mean, say starting 25,000 to about 25,500 between those strikes. It would have been absolute catastrophe, right?
Absolutely. Yesterday, the losses have been anywhere around 8 crores of option writing bets were trapped. And that's why the short covering also was equally ferocious. And once it crossed the congestion zone of 25,150 to 200, the short covering just blew off, and we saw the index move right up to 25,500, close to 25,500. And it has closed above that. So technically, the setup is good. But as far as options data for next week is concerned, we are still sitting at 25,500 as a resistance. And today being a Friday also, I think some profit booking can occur. So trading approaches, you book out profit here, wait for some retracement up to 25,200 and reinitiate longs in the index.
All right. Take that point. Thank you so much, Avni, for joining in and giving us your views on the market, the indices, and the trading strategy for today as well. Book profits now, buy closer to 25,200 is the call coming in. But a lot of action that took place in the pharma space, not only yesterday, but the previous trading session as well. A lot of pharmaceutical stocks doing extremely well, largely on account of the US passing the Biosecure Act. We have Aditya Khemka, who's joining in. He's the manager, of course, at Incred Healthcare Portfolio. Aditya, so much happening. On the one hand, the positive is the Biosecure Act, but then the other are the run-ins that have taken place from the US FDA, especially for names like Granules. And the third one, of course, is Biocon, not looking to sell out, and as a result of which, that stock under pressure yesterday as well. Your thoughts on the space right now? Your top picks.
So on the CDMO space, because of the Biosecure Act, we expect the order book to swell up over the next 5 years, and we expect execution to take place between 5 and 10 years. So let's be very clear on this. This is not something that can, impact the earnings of the next 1 or 2 years, but it will impact earnings over a 5 or 10 year period. And the capacity expansion has already started across CDMO and contract manufacturer players. So we believe Biosecure Act is a big positive. It's a mega trend that has to be participated in by all investors, and it will play out over the next decade. In terms of the US FDA regulatory issues, if you look at it, ironically, smaller pharma companies and companies which are on the contract manufacturing side tend to have lesser issues like that. And companies which are more generic in nature, unbranded generics, like the names you mentioned, they tend to have more issues like that. So that clearly tells you that it's not the US FDA that is the problem. It is perhaps the controls and the measures and the SOPs that these companies implement within their facilities that is the problem. But that I think is something that is a learning process for these generic pharma players, and they will have to continue to invest in quality and SOPs to prevent such issues.
Okay, so since we are discussing FDA issues, Aditya, let me ask you whether Granules is indeed under your coverage. Do you cover the stock?
We do cover the stock, but obviously we don't own it, so we don't talk about it. At the end of the day, any pharma company that has had data integrity issues in the past has received an import alert. And if it is an import alert for a company like Granules, then revenues will stop and costs will swell up. That's a double whammy on their bottom line generally. And that does not end well for the next 1 or 2 years. I mean, generally, import alerts take 2 years or more to get resolved. So it will be a very painful period for investors in the stock for the next 2 years.
Sure, absolutely. And I mean, a lot of that was playing out yesterday itself because the nature of those observations is pretty scathing, to say the least. Okay, on to the larger point and the takeaways from this US Act, which is looking to perhaps alter supply chains because they don't want to do as much business with the Chinese now, so therefore opening up the opportunity for Indian CDMO players. From what you say, this seems to be a build-up over a distant horizon, a number of years ahead. But from the perspective of the here and now, if you talk about some of the top CDMO choices, some of the companies that you're most bullish on, which could also be beneficiaries of the Biosecure Act, what are the kind of players and the names that you're liking?
So the names that we own in the CDMO space are Syngene, Jubilant Pharmova, Vimta Labs, and Hykel. These are the names that we like. Obviously, there are other beneficiaries as well. There is Laurus, there is DVs, there is Suven. However, we don't own those names simply because either we don't like the earnings growth trajectory that we anticipate over the next 2-3 years, or we don't like the valuations at which these stocks are trading. And hence, we pick and choose from the CDMO space as to what we want to own.
And just tell us your valuation comfort band, and what do you think would be fair value for CDMO players, and where you'd probably call it excessive and sort of check out?
Sure. Look, what you have to understand that some of these companies are actually conglomerates. They have the CDMO business, but they have other businesses as well. And hence, to give one multiple across these companies would not be fair because their different verticals would deserve different valuation multiples. However, just purely on the CDMO business side, I think something around 20 to 25 times EV EBITDA or 30 to 35 times PE multiple is something that we'll be comfortable assigning. But having said that, please remember that these companies are conglomerates. They have other businesses as well, which are probably lower margin businesses, lower multiple businesses, and hence the conglomerate multiple will be lower.
Aditya, of course, you manage a fund, so you gave us those 3-4 names, right? Best top picks. But if you had to pick one out of those names for viewers who are watching, I mean, it's a long-term hold. What are you most comfortable with?
So we have the highest exposure to Jubilant Pharmova as a stock. Obviously, it's the CDMO player, but they also have radiopharmaceuticals, which we are very excited about as a space. We think it's a space with great growth potential and very high profitability. So within all the 4 names that I mentioned, the highest exposure that we have is to Jubilant Pharmova.
Right. You've given us the timeline of the accrual of gains coming in from the Biosecure Act. What we want to understand is the size of the opportunity as well. If you could give us some sort of indication of this is the kind of business that may accrue to all these players because this is the size in the market right now and this is the addressable market or the capacity that we have.
Yeah. So look, last I checked, the export of API from China was around $40 billion. From India, it was about $4 billion. So you're looking some of the business from China to shift to India. Obviously, not all of it can shift. Obviously, it cannot happen overnight, cannot happen over the next 1 or 2 years, but it will happen over the next 5 or 10 years. Some of the business will shift. But you're comparing a $40 billion giant to a $4 billion company, to a $4 billion country. As a country, we export $4 billion worth of API. So the opportunity is 10 times if you ask me, but how much of it will play out in the next 5 or 10 years is difficult to say. But I don't think opportunity is the challenge. The challenge will be the capacity, the execution, the compliance. I think that is where the challenge really lies. Opportunity for this CDMO for Indian pharma companies would be very, very big.
Realistically, what is the business that we can get out of this?
Sorry, could you repeat that?
I was just wondering, realistically, you said the opportunity is $40 billion out of versus the $4 billion that we do right now. How much incrementally can come?
So again, that's a very difficult guess to take because it depends on how much capacity we build, how well we execute. But if you take, let's say, a 20-30% market share gain versus China, I don't think that will be a bad assumption. So $8 to $12 billion can shift over the next 5 to 10 years.
Okay. All right, got that, Aditya. Thank you very much for the summary of what promises to be a pretty big long-term milestone for the industry. With that, let's quickly get back our eye to the screen. 41 points up in the pre-open. That's where the Nifty is at. Mitesh is with us for some final calls at 9:10. Mitesh, so what's it going to be?
Yeah. So I think ACC looks set for, some kind of a bounce back. Look for targets of 25-50 here.
Okay. All right, Mitesh, got it. Thank you very much for that. Let's move on and look at some interesting brokerage notes that have come in. And some of these calls on Samvardhana Motherson are actually on the downside. We've got Vinny joining in with the latest. Vinny, which are the notes you're looking at?
So yes, two notes. One is from Investec and the other one is from Citi. So let's start with Investec. Now, they've downgraded the stock to a hold. Target price is 195 rupees per share for Samvardhana Motherson. The key highlight is that there is weakness in the European markets, and 36% of Samvardhana's revenue comes in from European markets. So weakness there is expected to impact the company's growth going forward. And even the recent commentaries that we've seen from global OEMs in terms from BMW recently, they also say that this weakness is expected to continue in the second half of the year. So yes, because of this, Investec has cut the EPS target by around 3 to 5% for FY25, FY26. And let's not forget, the stock has seen a very good run up versus the Nifty on a YTD basis. When you look at it, stock was up almost more than 80%. Nifty is up almost, versus the Nifty, it's outperformed. So maybe now we could see a bit of a decline coming in. That's the word from Samvardhana Investec on Samvardhana Motherson, while Citi too has given a sell rating, maintaining its sell rating, target price of 105, and they've opened a 90-day negative catalyst for the stock. Believe that there is weakness in the auto markets globally also. That is a trend that they're expecting in terms of volume, and OEMs cutting the volume guidance is a big concern, and EU weakness, China weakness is something that even they are keeping an eye out on.
Vinny, thank you so much for that. So Samvardhana Motherson is a stock that we'll keep an eye out on. On the downside, brokerage is not particularly pleased on the way forward for the stock. But the telecom space was a buzz yesterday. The top Nifty gainer was Bharti Airtel. Rima joins in with some brokerage notes on Bharti and Bharti Hexagon as well. Rima.
Thanks so much for that. So let me start with Jefferies, where there is an upgrade on Bharti Hexacom to a buy, and their target price stands at 1,600. Now, the key thesis behind the upgrade is that there are multiple tariffs in store. So earlier, their expectation was that the next tariff hike will take place in Q2 of FY27. Basically 2 years hence. But now they're saying that we could have another tariff hike next year in Q2 of FY26. So basically a 10% tariff hike next year and the year following. Now, why they're expecting that? One, Jio is focused on growth. Remember at the AGM, Mukesh Ambani said that he plans to double Reliance Jio in the next 3 to 4 years in terms of revenue. So for the company of that size to double, they will need tariff hikes. Secondly, even Vodafone Idea continues to lose market share. So if the company has to meet its cash flow requirements on a declining subscriber base, they will need more tariff hikes. So they believe the environment is constructive for multiple tariff hikes from here on, and Bharti Hexacom is best placed to play the increasing tariff game, and they're factoring in a 19% revenue growth, 65% EBITDA growth, and a cash flow jump of 66%. On Airtel too, Jefferies has raised the target price to 1970. Back to you.
All right, Rima, thank you very much for that. So keep an eye on all those names. That's the opening bell going off. What do we have in terms of first rates? It's a flattish start and almost immediately in the red. So 25,370. So around where we left off yesterday is where the start is at. Since it's like a traffic light. I mean, 82,925, basically just blinking. with and changing color. But yeah, I mean, maybe a little more decisive, 25, 30 points down on the Nifty and about 70 lower on the Sensex. Nifty Bank is absolutely flat for now. Mid-cap index has got a bit more green, 0.25% higher is what you have. So that's the overall picture. I think there are more down than up on the Nifty. The heat map is coming up on your screens. And yeah, I think there is, there should be about 20, 22 names which are higher, but there are, a few more which are lower as well. So the start is mild, subdued, and it's a Friday going into a weekend. 50 points now, 40, 45 points now after yesterday's tremendous stage. So actually, from yesterday's high now, this is a full 120 odd points, 130 odd points lower. But this is the first few seconds of market open.
Prashant, well, I'll tell you what the most exciting stock, the one that Rima was just talking about, Bharti Hexacom. The market has really taken note of that Jefferies report and the kind of higher price target, substantially higher price target that they have. Stocks jumped about 6.5% right at the open. We'll get to more newsmakers in just a bit. But first, on the Nifty, the traffic lights that are blinking red and green, as Prashant says. Well, on the green side, there's Bajaj Auto with a gain of about 1%. Hindalco, Tata Steel, JSW Steel. So all the metal stocks are having a good open, up about 1% each. Wipro, Nestle India, and TCS. These are some of the other names on the way up. And then it starts completely fizzling out. On the lower side, there's Divi's, which is down about 1%. Some cool off on Asian Paints, Adani Enterprises, Ultratech Cement, Coal India, Bharti Airtel. So Jefferies also optimistic on Bharti Airtel, but that call's not really reflecting that much. It's Hexacom where the target price is much higher than the CMP, which is why the market's excited about that particular call. And then it's very, very flat out there. So not much moving on the index. It's far more about individual stocks. So let's get to it, Manglam.
Individual stocks, 1,400 stocks, 1,500 stocks now as we speak, advancing for just about 500 stocks which are declining. So market breadth firmly in favor of advances. Among the top gainers in the F&O pack definitely are the gold financiers. Gold prices hit a record high yesterday. So Manappuram and Muthoot doing extremely well. Metals also doing quite well. So we have Nalco and Vedanta, both of them sitting with gains of almost 2.5%. Z Entertainment pops up on the gainers list. But on the losing end, we have Samvardhana Motherson. Brokerages, have downgraded the stock. Vinny just spoke about that, down 2% right now. And Granules is the other one. After a 16% downtick yesterday, the stock entered F&O ban, and that follows up with a cut of almost 3.5% on the way down as well. On the way up, though, apart from Hexacom, which Surabhi pointed out, we have Edelweiss Financial, which is up around 8%. We're seeing some traction in Purvankara as well. They bought land in Breach Candy, Bengaluru, as well as Lokhandwala. So all those factors playing out for Purvankara, up around 4.5%. Tirupati Balaji Agro, listing yesterday, which gained about 14-15%, has now followed up with a 5% up move on that counter as well. And as we speak, the Patanjali large trade has taken place already. Nearly 1.2 crore shares or 3.3% equity changing hands. Patanjali Foods down 3% at the open on account of the large trade where promoters have looked to pair stake, and that's what we gather from our sources.
Godrej Agrovet, guys, is the biggest volume-led gainer right now. And we don't see that on the volume leaderboard, but it is coming up, 815 now. I think you mentioned some of the others, Varun Beverages, Bharti Hexacom. Nalco is coming up with a 3% pop as well. Nalco at 185. And look at Edelweiss. I don't know if you guys mentioned it. Edelweiss at 124 is up 9%. That's a surge. Edelweiss is a large mover. And by the way, it's done very well. Last 3 months has been phenomenal for this one. So it's almost now a 10% move. Backed by volumes, that's the only reason I'm mentioning this here. Lodha is up about 3%, 1,234 on Lodha. There is IDBI, which is up 4%. So stocks at about 91. Saxoft is up about 6%, 6.25%. I mean, this small jeweler, Moti Sons, last few days has been buzzing. And I think for the week, now it's up about 32%. So that's doing well. Yatharth is up about 3%. Yatharth Hospitals, that is. So decent volumes. Viatech Vabag, signs of life this week once again. I think for the week it's up about 10% and 4.5% today. Tribhuvan Das. I mean, actually, some of these older, smaller jewelers, that is TBZ, 3% on this one as well. So that's a theme which generally is done and worked out very, very good. On the downside, Granules, Patanjali, Motherson, I think we mentioned most of these. Kim's is, okay, I think there is a corporate action there. Inox Wind is down about 2.5%. PNB Housing has been a big re-rating candidate, right? 800 to about 1100. So about just under that level right now. Fluorochem, Adani Power, Asian Paints are some of the other volume-led losses, but nothing large. Between 1 and 1.5% is what we're talking about. 40 points lower is what you have. Rahul Arora is with us, CEO at Nirmal Bang Equities. He's with us here in our studios. Rahul, great to have you with us here. Thanks very much. So, I mean, just a quick word on yesterday's session, if you want to weigh in. I mean, you don't see those very often. I mean, I'm not making too much of it, but it was a big deal, right? I mean, the kind of surge that we saw, and especially the data on the option side and what has happened. And I was saying earlier that all that talk of, these foreign algo firms yanking markets at will whenever they want, I think that's going to come back. That's going to resurface. And we don't have any evidence. Well, that is what happened yesterday. But sure enough, I think a lot of call writers got killed.
So first off, morning, and thank you for having me on the show, and festive greetings. So I think everything that's happening, let us submit to the divine. Ganpati Bappa mode. But no, I think on a serious note, Prashant, I think one is obviously the data that you're talking about. The second is, I think, I think ever since Ashish of Axis Mutual Fund wrote that note about promoters selling and, the kind of corroborating it with the SIP inflows. I think if you look at the last 2 months...
talk about his note on derivatives, because he wrote one on that one as well. The size of derivative market options, etc. But go on.
True that. But I think if you see the last 2 months, right, I think if you look at promoter selling, it's about 85,000 crores. That's 2x the SIP money that's come in. The question is, where is this money going? And I think, Prashant, you've been in the market long enough to know that there was a time when promoters sold stake, the stocks used to get derated.
Yeah.
Here, there is a queue. Ki mujhe pehle milna chahiye. And which is very surprising. This is a huge shift. And now why is that happening is because of the force of liquidity. I think, the kind of money that mutual funds are sitting on, and we've discussed this, I think, by all stretches, I think if you include mutual funds, AIFs, PMSs, family offices, and you look at cash levels, that's about 1.5–2 lakh crores of cash at any point in time in the system. That's 1/3 of the size of the mutual fund industry pre-demonetization. I mean, that's the magnitude of what we're talking about in terms of liquidity. So you have a counterbalancing force. I think, the other day I was talking to a slightly senior sell-side person from our industry, a much bigger competitor of ours, and I was like, how is the Asia-Pacific region going? He's like, abhi yaar, Asia ke trips itne kaun maar raha hai jab, SBI is 10 lakh crores, iPro is 8.5 lakh crores, HDFC is 8 lakh crores, and, Kotak and Birla. So the kind of depth that the domestic markets have seen, I think to just play on the word that you've got, I think the FI money is an option value in the Indian market, so to speak, right now. And I think I heard you spotting some of the real estate stocks. I think that promoter selling money is either finding its way back into the markets or it's going into real estate and high-end real estate. I think if you see the kind of sales that even high-end real estate is doing. Now, do valuations concern us? They do, at a broad level, honestly, Prashant. I think we just got lucky that crude has traded between 65–70 for the last week, 10 days. The external sector in India has been good. There's no question. Our rupee has behaved itself. Crude has behaved itself. And our forex reserves are perfect. There's nothing really wrong with that. We are staring at interest rate cuts. How much, we don't know. But even then, are we justified for a 25–26,000 Nifty? I'm not so sure. So, hand on heart, I'll give you a final data point. If you ask all my analysts, hand on heart, to look at the last 3 and 5 years PE averages and project growth over the next 2 years and ascribe a realistic multiple X liquidity, my sense is 80% of my stocks under coverage, and we track about 180 odd, will be sells. That is just, I'm being very honest upfront on national television that this is what it will be. We don't know what to do with this liquidity. And so therefore you are only doing two things. Either you're constantly rolling forward, or then you're saying, forget the conventional PE and EV EBITDA and start doing DCF. Now, once you do that, how can you project cash flows in certain businesses beyond a point? Consumer, I can still understand. So there is a certain level of irrationality, and which is why when I was last on the show, I think a month and a half back, we discussed our downgrade on defense. We couldn't understand it. Some of our competitors still have buys, and good luck to them. But sometimes when you don't understand it, reason has to take over liquidity at some point. So I would advise people to be cautious at this level.
Rahul, just earlier we had Arindam Sanger of Geosphere on the show, and we were having the same issue, the same discussion on liquidity, right? And I was making the point on Bajaj Finance just being a simple case in point that a company goes out to the market to ask for 6,000, 7,000 crores. The market wants to hand it over 3 lakh crores, right? That's the sort of situation we're in, and also the company that Bajaj Finance obviously is. Now, your conversations with some of your foreign clients, I know they're no longer maybe the hottest clients, as you say, but what's the sense there? Because till the time this Nasdaq rally continues, I think it's fine because they'll still keep looking at the home market. The day that starts petering off, they will remember markets where they don't have adequate positions built, and India is probably one of those markets. So what's the chatter you're hearing on that side, given that we're getting to the rate cut next week?
No, so I think this would be the one clear directive that comes when you speak to any investor anywhere is India is still growing at 6.5–7%. That's still a remarkable growth rate by any stretch. I do understand our aspirational growth rate could be 8 to 9%, but at 6.5–7%, you're gold. You know, I think add to that when you're talking about interest rate cuts that you've seen, you are going to see a little bit more of the yen carry trade unwinding a little bit as we go forward. I think if you look at the way the yen's been behaving, it's not, I think that one-day trigger is probably going to repeat itself, maybe not with that level of magnitude, but I think India could potentially be beneficiaries going forward. Now, if you heard that Trump
more
was...
money, which
absolutely.
Brings you back to the question, how are we going to deal with so much money?
You know, like I said, Survi, I think what's happening is that industry leaders are getting outsized in terms of valuations. And I'm not even talking large caps. I mean, look at Indian hotels and hospitality, look at Dixon Technologies and EMS, you can look at hospitals. I think what's happening is that the industry leader is becoming disproportionately larger. Look at IT services. I think look at the difference between TCS and the rest of the pack. You have TCS at 30 and you have Wipro at 20. So there's a 33% difference, and this is a large cap name. So, you know, I think that's probably what's going to happen. But I think India could potentially, I don't know whether we will get a disproportionate share, but I think the one thing that the last debate between Harris and Trump taught us, I don't think either of them are too clear on their policies. So if that happens and you will get into a situation where obviously one of the two is going to win, but if they're not very clear on their policies, and I think you have a market like India which is going to go into an interest rate cut cycle with 6.5% growth. But I go back to the point I was making to Prashant, Survi, I still don't think, see, India's earnings are going to be driven by top line. Everyone's cut employee costs, everyone's cut subcontractor costs. They've squeezed every bit out of margins from crude. You've built up low-cost inventory. India itself, you know, when the Russia-Ukraine war started, built up inventory at 40, 45. Your growth has to be driven by top line, earnings growth as well. That visibility, you know, as when we talked to a lot of, I was with V-Mart Retail the other day also, he said, itni visibility nahi aa rahi. 13-15% ka growth top line mein aa jayega, which means you're talking about a 14-15% earnings growth. Now, for that, do you want to be paying 23 times to the Indian market, 22, 23 times? But then again, you know, as somebody very famous once said, markets can remain irrational far longer than you can remain solvent. So.
Well, you know, you did speak about the point that the leaders will get disproportionately rewarded. What's also happening, the counter to that is that because leaders are getting disproportionately rewarded, now people are looking at the valuation gap between the leader and the significant other. And as a result of which, we've seen a big rally in the others down the quality line as well, not necessarily, you know, as good as the leader. Jewelry sector, that stands out in particular. The last 1 year or so, Titan has underperformed. 2 years ago, Titan was trading at a 3 times premium to say someone like a Kalyan. Now that premium is just about 10%. How do you play this now? Do you stick with the leader because the premium has come down, or do you stick with the other one because on a low base they will grow faster?
So I'll tell you the first thing that comes to mind, Mangalam, when I look at historically how investors react to valuations. They will play this valuation gap, but at some point it will revert to the promoter that they are more comfortable with. That literally just happens. I think the determining factor, the single most determining factor, and which is what we're taught in school as well, that beyond a point, the valuation that you will be paid for is for return on capital employed. How you are basically employing your capital, how you are rewarding your shareholders. So that valuation gap can play up to a point. But let's take IT services as an example. Wipro hasn't re-rated to that extent as say a TCS or an Infosys has, right? Persistent has always been at 40, 45 times. There have been some ER&D players who were at 20, 25 times that have caught up, but the valuation gap still remains at about 30 times, so 30% between them. So I think from here, you look at prudent capital allocation. You know, there have been some companies, and I don't know how actively you guys track this, but a lot of companies that have come up with IPOs, if you look at their objects of the issue, not all of that money has got deployed as well.
Right.
You know, sometimes I wonder, you know, on a lighter note, whether some of that will also find its way into the capital market and they'll make the returns and they'll increase the dividend payout. But, you know, that's on a lighter note. But I think at these valuations, if you're going to get similar growth rates across the sector. Let's take, again, just coming back to ID services, I think on a blended basis, if the sector is going to grow 8%, you will have TCS probably growing at 9-10 and the others growing at 5-6. Right, but if you're comfortable with the kind of capital allocation and promoter and dividend payout that TCS has, I think the trade may just come back to something like a Titan over the others, and that may just correct itself.
So given all that you know right now about the markets, the valuations, the liquidity, etc., where do you put your money?
So the first thing is I don't know anything about the market, and I don't think too many of us know, but I think you really have to find value where and it's difficult to. I'll give you some stocks like, let's say, Surbhi alluded to Bajaj. I think, if you look at trailing, Bajaj is coming at 3.3 times. It's not listing cheap, but then you'll obviously have a good, listing gain. But you can look at names like Repco Home Finance. I think that's still coming at 0.7 times price to book. That looks interesting.
Bajaj, by the way, it's going to be a doubler on
for sure it will be. For sure.
So then valuations are at what, where?
So if you look at what Bajaj Finance has traded at,
which is what someone said, it has to be at least 8
or
times.
Gru Finance at one point, Gru was trading at 7 times price to book.
Right.
Of course, Gru has never diluted. And that's
but
the
I think that era is over, isn't it?
It is, but
5 times, 6 times.
Of course it is, but I think that is probably what will happen, right? Bajaj will list. It'll probably list at maybe 1.5, 2x the issue price. The question is going to be then what? I think even on a post-diluted basis, I was just speaking to my analyst, I think she was saying it's coming at somewhere around 2.5 or 2.7 times. So even if it doubles, you're talking about 4.5, 5 times straight there. HDFC, any of the stocks that you take, whether it's HDFC Life, price to embedded value is about 2.4 times. If you take the parent, which is the merged entity, that's coming at about 2.3 times. These are all traded at 4.5, 5 times. So, I mean, even if you have a 25-30% growth rate, we've discussed this in the past, Prashant. Bajaj Finance, DMart, Asian Paints, these guys get so priced to perfection that margin for error bilkul nahi hota. Thoda bhi agar, if you're 30% growth rate and you come in at 26%, you'll find the stock down 10% because you're pricing these for perfection. And I think that's the same thing happening with Bajaj. But I think in BFSI, like I was saying, I think Repco is a good trade. We were discussing, we alluded to jewelries. I think Muthoot is still a good trade. And, with all that's happening in housing, I don't know whether it's a name that you guys discuss often. We like Housing Urban Development Company, HUDCO. Coming at about very similar valuations to, say, a Bajaj Finance right now, but 25-30% kind of growth rates. There is some pockets of value still in cement. If you look at the valuation differential, again, going back to the point you were making, Ambuja is still trading at a discount to Ultratech. JK Lakshmi is still trading at a discount to some of the larger peers. Chemicals has been out of flavor for a while. I think, you've had a great run in fluorination with SRF and Naveen. We like oleochemicals as a space. So Galaxy Surfactants could be an interesting name. So it's not like there is no value whatsoever. I think the only place where you're going to absolutely struggle from a valuation perspective is consumer, because those valuations have been very good over the last few months. And I think if you look at QSR, Alcobev, Staples, any discretionary hotels, it's very difficult to justify. So I think if you get like, a little over fixed deposit returns, like 8-10% kind of compounded returns, you should be happy. But I think some pockets of the market still have some amount, but you can't just aggregate, say that, this is where it is. That's the sort of limited point.
It's not an easy market to be in. You have to really dig deep to find little pockets of value wherever they exist. Got that point, Rahul. Thanks very much. Good to have you in the studios this morning. Thank you very much for being with us and sharing the perspective there.
Thank you.
Well, we have to move on and get to our next corporate conversation. And the company on our radar is actually Thermax. Now, Thermax has entered into a strategic collaboration with Cirrus Power for manufacturing of electrolyzers. To discuss all the details around this development, the opportunity, the outlook, we have with us Ashish Bhandari, MD and CEO of Thermax. Mr. Bhandari, good morning. Great to have you with us on the show. So let's start with, all the bare basics. This is a big alignment that's happened. So how does it work? What's the tech transfer, the royalty, the revenue share, and the opportunity itself? Just break it down. Where will it place Thermax in the entire electrolyzer ecosystem?
Okay, I'll answer it in 3 parts. First is the choice of technology itself. Thermax has chosen to go with solid oxide as the core technology around which we would do our development. And we have preferred it over a couple of the competing technologies like alkaline and PEM, because we think for India's industries where decarbonization through hydrogen will happen first, which is fertilizer, steel, refining and petrochemical. In these industries, the application for SOEC as a technology is very high.
And that is because there is a high heat requirement for this technology, which has the capability to deliver much higher efficiency than other technologies. So that is the choice that Thermax has made. It aligns very well with our strengths. And because we are at the core a company that understands heat management very, very well. So that is the idea. Second, it's a licensing arrangement where some of the core technology elements will be provided to us by Ceres Power. It's a non-exclusive global license. So I'll talk about both the words. It's non-exclusive, which means the license that is given to Thermax can be given to others. And we are comfortable with that. We think we can develop products that are competitive and can stand on their own. More importantly, in our mind, it's a global license, which means it's not limited to India. We can take our products that we develop and we can sell it anywhere, everywhere. Third, in terms of the terms, what we are comfortable sharing is of course, there's a fee to the license and everything else. There's a very direct and a very specific technology agreement, which means Thermax will obtain technology with very specific agreed upon technology capabilities around which we will develop all our products and everything else. There is a royalty. The royalty terms are reasonable in our account, not shareable at this current moment. What we will result in is a prototype development over the next 1 year, followed by manufacturing plant, and then after that, much bigger, wider scale deployment.
Right. You know, the street likes what you're saying. It's, in terms of the opportunity, the terms of the deal that you have, and the business plan that you have. If you could give us some more details on this, if you could give us a sense of what the total addressable market is, when do you start bidding for electrolyzers, and what could this be in terms of potential revenue and margins for a company like you going forward?
Look, I'll share what we know. Yeah, and there is a lot in this space that we don't know. What we don't know is how the space will evolve, because there are a lot of policy-related discussions. Also, in terms of choice of technology, we have made our choice of technology, but we know there are other competing technologies, and especially there is the load of players out of China where the price points are just very difficult to determine what they are today and what they will be in the future. So there are some geopolitical ramifications as well. And third is adoption. Yeah, so of hydrogen overall, not just about SOEC, about hydrogen overall. So there are a lot of moving parts, but not doing anything is clearly not an option either. Yeah, so which is why we have chosen our path. So with that said, broadly, what I think, and we'll have to take a longer look. If you look at 2030, I suspect the market for electrolyzers in India will be a few $1 billion. Yeah, and in that, how big will SOEC be? What Thermax's share would be remains to be seen. Even profitability will be driven by competitiveness, but I hope at least 10 to 20% market share should not be something we cannot aspire for. Yeah,
okay.
But there are a lot of moving parts.
Okay, no, absolutely, and I think you described it so well. Congratulations on this sort of new segment. Thank you for joining us, Ashish. If I can ask you to, so you said billions of dollars, roughly. Was that? Is it?
So it could be anywhere. Yeah. I think my personal number of what the size of the market would be somewhere between $2 to $5 billion. Yeah, that is. So very wide range, you would say, and I would say there are just too many open questions right now, even to come up with any number. I think the focus should be on what we can work on and deliver.
Yeah. So
and if we do that right,
just to narrow the focus, the mind a little bit more. I know this is all projections, and I think our viewers understand that as well. And you made it amply clear there are lots of variables and moving parts. So if it's, say, for example, $3 billion, right, by 2030. You're saying you should be able to get a 20% share of the market, right? That's about, what, $600 million?
Yeah, I don't think that's... Go ahead, sorry, please.
And what kind of rough margins, again, all projections?
All projections. Yeah, absolutely very little idea on what it would mean. I think, look, you start with fundamentals of what the world of the future needs, and you're very clear hydrogen is going to be a big part.
Ashish, if I can ask, got it. Let me just ask you two more questions. Does anyone make electrolyzers here in India right now? That is one.
Right now,
I think, is it all imported?
Right now, predominantly imported in a segment which is very, very small. As you know, as part of PLIs, there are a few companies who have committed to making electrolyzers in India over the next 3 years. Not one of them is based on SOEC technology.
So, since we don't have immediate numbers to work with in the here and now, Mr. Bhandari, I want to go back to just understanding this. Like you said, the opportunity size could be $3 to $5 billion. That's the green hydrogen opportunity in India, right, that we're talking about up until 2030. What gives you the confidence that this particular technology that you have opted for, SOEC, that this will win more of the market share? And just give us some time to market that you have in mind. By when will the technology transfer happen? When will your plants come up? And by when do you actually hit the ground?
Okay, let me take both of those questions separately. First, in terms of why we think this is the technology to work with, I'll repeat, it is very well suited for the kinds of industries that India looks to decarbonize. Yeah? And I shared my steel, fertilizers, refining and petrochemicals. Those are the four primary industries. And the reason for that is the SOEC delivers much higher efficiency, but trades that off with higher capex requirement and especially requirement for heat. And in these bigger process applications, heat is available. And Thermax is very well versed in how do you optimize heat in a process and in an equipment. So that is where our capability comes in. We think it's a very good fit for what India needs and what Thermax can do well. Yeah, that is the primary driver.
Yeah, and by when? Yeah, and by when will your plans be up and running? Yeah.
Look, in terms of, the technology transfer is immediate. Yeah, we are getting started running on the ground immediately. When would products be available for? I wouldn't say we would have to wait 2 years for the first products to become available, and 3 years for a full-scale plant to be available.
Right. And finally, before we let you go, since we have you with us, if you could give us a sense on the non-electrolyzer, the current part of your business, how execution has been in the second quarter so far, order inflows, margins were a little under pressure. Have you seen some bottoming out there? How does the next couple of quarters look for you?
Look, I continue to stay optimistic. I don't think it's, I think maybe 2 years ago, right after COVID, there was a period where orders were just coming in. We are not in that phase anymore. There's a lot of opportunity, but you have to fight for it, and you have to be doing new things, which is what we think we are, even beyond hydrogen in almost every part of the business. So overall, optimistic, and that Q1 was on the margin side. We took some hits, and hopefully that's the end of it, given we are just 10 days to or very close to finishing the quarter overall. Too early to start predicting and not right to predict, but overall optimistic about what the future holds.
All right. Ashish, we'll leave it there. Good conversation. Thank you very much, and good luck as you sort of build that side of the business out over the next couple of years or so. And of course, we'll speak after you have you report the numbers for the quarter. As you said, we're very close to finishing it. Well, let's focus on the next one. Nazara Technologies is the company that we're going to talk about. And Nazara is investing 982 crores in Moonshine Tech, which owns online poker gaming platform PokerBaazi. And we're going to talk more about this. We have Nitish Mittersen, a Joint Managing Director and CEO at Nazara, joining us now. Nitish, good morning. Great to have you with us here on CNBC-TV18. Thank you for your time. I dare say the buzz or the vibe overall is waging a bet, be it in poker or be it in the stock market. So I think the acquisition is in tune with the times in that sense. But congratulations. I think it's the largest acquisition for you so far, by far, right? So tell us a little bit about this. How much cash are you putting to work? because there is a... Oh, oops. I think we'll
For the
have...
longest time, we thought he had a poker face. Little did we know that, it was the connection which was making it
That's a good
the way
one.
he was. What can one say? We'll just try and repatch that connection. But, big acquisition, near 1,000 crores.
And the point, Mangalam, they've done acquisitions, small acquisitions, like 150, 200 crores.
Right.
I mean, actually, last time I spoke with them, I said, well, it's almost an acquisition a week.
Yeah.
That's the pace of these small acquisitions they've done. But this is, as Rima earlier said, I think the revenues of the company are about 450 crores.
Yeah.
So that's about 40% of what the annual revenues right now are. And this, of course, also takes away a significant portion of the cash on the books.
Yeah.
So I think there's a lot to talk about. But as soon as we have, a stable line with Nitesh.
What's also interesting is that earlier, real money gaming accounted for sub 10% of their overall revenues. Now with this being added and this accounting for nearly 35% of their overall consolidated revenues, what does that do to the overall, mix of the business? And in light of the sort of regulatory issues that are surrounding the real money gaming issues, how does the company navigate through all of this? Something we'll be watching out for.
I guess in the past, Nitish has always maintained that as long as there's absolute clarity and certainty and stability on the tax rate, even if it is 28% GST, I think players will learn to live with it and move on. And maybe that's the premise on which they've gone ahead and decided to deploy almost 1,000 crores towards this particular acquisition, like big one, like you said, 982 crores to be precise.
I can tell you, poker is, I don't know, you guys play poker? I don't. I mean, I've been asked to learn and almost coerced into learning. Maybe I will get there, but people who play,
fans.
They play through the night and wake up in the morning and go to work, and it's serious out there, and large amounts of money being bet. And I'm talking about sort of people like you and me.
Yeah, the age-old saying is that if you want to know the character of a person, play poker with that person. Because given the sort of skill that is required for you to, calculate probabilities, there are tells, and then there are, the way a person plays, whether he's aggressive or bluffing through their eyes. All of that, you get to know a person really well when you play poker with them.
I played once and I won. I think
that's called beginner's luck.
Exactly. So that's why I've not tried my luck the second time.
All right, and talking about beginner's luck, I think we have Nitesh back with us as well. Yes,
let's welcome in Nitesh now. Nitesh, hi, good morning. And I think the line was frozen earlier, and we were making the joke that you got a poker face on, but that was clearly a bad line. So let me begin again. Congratulations, big acquisition. I think the biggest that you've done by far. Talk to us a little bit about the mechanics of the deal. This will drain out a substantial amount of cash that you had. It'll leave you with very little cash. How are you sort of funding this? Will you look to raise more money? And then we'll actually talk about what you've acquired and the prospects there. Go on.
Sure. Prashant, as you know, Nazara had raised, significant cash in the last year. And we have been selectively making acquisitions where we think will add significant scale, growth, and profitability to our platform going forward. We've been quite patient about it, built a very strong deal pipeline, and have got a lot more active in our M&A in the current year, I would say, in FY25. I think with this current PokerBaazi transaction, they are the market leaders by far, over 55% market share, a fantastic team, and significant growth. We put out some numbers and you can see how they are growing. So we think it's the right bet for us to take. We are very excited about it. In terms of cash reserves, we continue to be well funded. We are a cash flow positive company generating free cash flow every year. And we will continue to be acquisitive, in opportunities that we like. We may raise some additional primary capital as and when we require it.
So could you tell us before this transaction, because you did 2 other acquisitions before this, right, in quick succession. So how much cash was there before this acquisition? After you pay this out, how much will be left? So you're paying out about 700 crores in cash for this, right? How much cash will be left in the books? And you said you may do another round of fundraising. I mean, the size and what's on your mind, and will it be very soon?
So we had 1,400 crores of cash on our books. Post the recent acquisitions of the Kidopia stake and the Fusebox UK studio, we had approximately 900 crores left. So we can fully fund this on our own steam, but we will also, look at getting some good investors on board. this is a good opportunity for that. And in the coming days and weeks, hopefully we will be able to achieve that.
And that will be a fresh issue of shares, Nitish?
Yeah. Yes.
So can you give us some sense on, let's say if you're going to go the QIP way, what is the kind of equity dilution you're looking at? How much would you want to raise by way of fresh equity capital?
So we haven't decided the route we will take, nor the amount, but we will partly fund this transaction that we are going to, pay out for.
Okay, so when you say partly, does that mean 50%, 60, 70%? We're just trying to get to some rough, estimates in size here.
We're still evaluating it. Our board will review the options, so we still don't know the right amount.
Okay.
All right, so let's talk about the here and now, Nitish. After this, deal that happens and post-conversion of your preference shares, what will be the stake that you will hold in Moonshine immediately? And post that, what are the plans for increasing stake further?
So right now, we will hold about 48% stake. This is excluding the 150 crores primary capital that we are putting in as CCPS, which we will trigger a conversion at a future date as and when we want to. So the CCPS will get converted at a future date at a formula as is linked to future revenue. And therefore, I can't give the exact post-conversion percentage right now, but it should get us closer to the majority stake in the company.
So at 48%, of course, it will not be part of the consolidated numbers. It'll just come as an associate or a little more than that. Is it a plug-and-play model? It's about 40% of your revenues. What are the kind of synergies that you believe you can attract from or achieve from a business like this, and margin improvement as well?
I think there are a lot of synergies. It's a consumer-facing product. We already spend a lot of time in marketing and a lot of ad dollars, so there could be economies of scale. Our esports division is very strong, and there could be synergies with Nodwin Gaming. So I think our team has worked out several synergies, but I think on a standalone business, this is in itself a very strong standalone business growing very fast. And therefore, we are not going to rush into synergies today. We want to just support this business and scale it in the next 2-3 years, and softly look at that we go along.
Nitish, what could be, how large is the market as such, and how large can this business become, in your opinion? I mean, now that becomes a bit of a projection, but what's your sense?
I think the skill-based online gaming market in India has been growing very fast, as can also be seen in the recent GST Council meeting outcome. The tax collected by online gaming has significantly increased. I saw it was about 400% increase to almost 7,000 crores in the last 6 months. So as you can see, this industry is growing extremely fast and will continue to grow as more and more people come online, more and more people are digital, right? This is the new world we live in. And I think the tailwinds are very strong for this business.
No, absolutely. That point is well taken. And I think this was discussed even before the GST meet that just concluded. The kind of revenue collection that the government is managing, because the market seems to have digested it, the reality of 28% GST on real money gaming. So Nitish, now just give us your targeted business mix in terms of the strategy going forward. How much is going to be real money gaming with this acquisition, and to what extent do you want to scale it up to? And then the other segments as well. I mean, there's still sports, there is the gamified learning. So in terms of the verticals and real money gaming itself, the focus going forward on this segment.
So for us, the core gaming business, which is, game studios that we own and develop games, for example, Fusebox or Kidopia or World Cricket Championship, remains a very strong core focus for us. And this will continue to grow. We will continue to be acquisitive in that space and also continue to be a high margin driver and cash flow driver for us in the coming years. So I think from a Nazara perspective, we are going to continue to focus very strongly on core gaming. We have the esports business, which we believe is also, we are the market leaders in that space through Nodwin Gaming and Sportskeeda. And again, it's a business with very strong tailwinds because that's what the youth really wants today. And we will continue to dominate that space and grow in the next 2-3 years. On the skill-based real money gaming space, one point to notice at this point of time with a 48% stake, we are not going to be consolidating revenues of this company. So it will remain an associate in our books and therefore will not have a direct revenue contribution to the business for the time being.
But eventually you're taking your stake above 51%, right? So I mean, when that happens, And just tell us if that's going to happen, maybe not in FY25, maybe in FY26. Then on a consolidated basis, what's the exposure to real money gaming?
Once we consolidate, it may increase to 15-20%, but I don't have exact maths right now because these are moving targets, right? Our other businesses are also growing, and we don't know at exactly what time we will consolidate, if we do consolidate. So I think we will have to see how it plays out in the coming years.
Just a final question before we let you go. Last year, this business grew at around 54% with margins at around 10% on an organic basis. What's the projected growth rate here? And you said you won't rush into driving synergies, but maybe at some point, you could give us a number in terms of the scalability or the cost savings that can take place because of these synergies. So on a steady state basis, what is the growth rate that you can project for this business and how much can be the synergies that you would add?
I think PokerBaazi is investing very aggressively in brand building, and therefore you will continue to see strong growth in the coming years as we report numbers for them as an associate. So I think we will continue to see very good numbers there. In terms of synergies, like I said, there are multiple synergies. Hopefully they will help increase EBITDA margins. In the longer term, I think this is a business that can generate very high EBITDA margins, but we have to kind of, optimize. For example, in recent year, the GST costs have gone up by almost 400%. So we will have to scale the business to be able to extract, higher EBITDA margins.
Okay. All right. I know this is a projection, Nitesh, but 2 years down the line, what kind of top line can we look at?
I really am not in a position to give a guidance right now on that.
Okay. All right. Maybe another time. Nitesh, thank you very much. Good having you with us here. Appreciate you joining in with Perspective. Stocks, by the way, moved into the green, but only slightly so, about 0.5% plus higher at this point. We'll take a break. We are back. More coming up on the other side.
Welcome back. The mid-cap index still holding up with gains of almost 0.5%. Briefly, there was a dip on the Nifty Bank, which was bought into and that has been sold into once again. So the Nifty Bank now sitting with a cut of 75 points. The Nifty 2 lower by about 0.25%, was doing well. We have the metals and the IT pack. Both of them well bid in today's trading session. Tata Steel has moved higher by about 2%. And we have Wipro as well, sitting with a gain of about 3%. Good time to get in Mitesh Thakkar for his views at 10. Mitesh, the first 45 minutes of trade are up. Your thoughts on how it's panned out so far and what one should do?
So, we are kind of slightly down, but that doesn't worry me. It just looks like, that yesterday's late surge, which happened in the second half, I think looks like a mild pullback to that. The Nifty is sustaining about 25, 280, 270 zone, which is where the closing pivot was when the last time it crossed 25, 300. So pretty okay with that. And the Bank Nifty is hardly down by about 60, 70 points. Again, I would therefore maintain a positive bias. On the stock side, I have 2 long or buy calls. Bosch, I think, is breaking out today with good volumes. So buy here with a stop at 34,400. Look for targets of 35,700 to about 35,800. And the other one which I like is India Mart. Again, a stock which is coming to focus after some underperformance. So here I would keep a very tight stop at 31.24 and look for targets of 3,200 plus.
Okay, all right, got that, Mitesh. Thank you very much for the trades at 10. We'll now move on to a CNBC TV18 exclusive. Trend plans to open 30 to 40 new West Side stores every year. In a rare conversation from the sidelines of the West Side Media Day with CNBC TV18's Shilpa Ranipeta, the company's CEO and COO talk about expansion plans and demand trends ahead of the festive season.
The fact is, with the 200 plus stores that we have, at our current run rate, we get over 80 million walk-ins. So a significant proportion of it are actually young. Right. And so therefore, do we address that segment? 100%. Do we address only that segment? Not really. Okay. So we are focused on them in a different way, in the way compared to some of the other brands. Right. And we want to be able to appeal to a headset and a mindset and not just an age group.
Are we looking at new categories or new sort of product ranges? Because you spoke about a lot of things that are new.
Everything has to be new. We're in fashion, and fashion's about newness. And for us, it's newness every Friday.
Right.
And so you've got to keep coming back to find it. Yes, we have a gifting collection. Yes, we have a new resort collection. fragrance collections, new footwear collections, new sneakers. I mean, I could go on forever.
Right.
So everything is new for the season.
Right.
Because we've got to stay fresh, we've got to stay relevant, and we've got to appeal to Gen Z, as you said. Indian people are holidaying. So we're playing into what's relevant. If they're holidaying, we're going to give them things to holiday.
Right.
If they're traveling, we'll give them an athleisure collection.
Right.
I think for us it's important to see what consumer trends are in India, and we satisfy that through our fashion offer.
Right, fair enough. And we'll talk about West Side also. Can you sort of give me a sense then, given the kind of consumer trends we're seeing, what can we expect from an expansion point of view? What do you have lined up for the year?
So we said in the shareholders meeting, we're thinking about between 30 and 40 stores every year. We've consistently maintained that we will do stores that stand up to a certain minimum standard. We're thinking of stores which are at least 20,000 square feet and more, iconic, and make a difference to each customer that she can relate to in a particular micro market.
Right. And how much of these do you see in a tier 2, 3 markets? How big are those? Because we're seeing so much aspiration coming out of those markets, and retailers are now increasingly focusing on these smaller markets, given the aspiration there. What's your sense? What are you planning for Westside there?
In many ways, Westside does not only appeal to Tier 1 markets. It's as relevant today in Tier 2 and Tier 3 markets. It's a question of whether we find critical mass, Shilpa, in a particular market, whether we find the right location, whether we find the right building scheme, and the economics work. If some of this come together, we're very happy, and actually very happy to be in multiple micro markets rather than in lesser number of micro markets.
Right. So that is an area that, I mean, Tier 2, 3 markets are something that you are looking at.
Indeed. We already have several cities where we are present, towns which we are exploring. So it's something which is clearly on the radar, but it is not in exclusion of what we do in Tier 1.
Of course, fair enough. And what about online for Westside? You know, the Westside store also standalone. You do how much of a focus do you have on that end? And currently, can you give me a sense of how well is the online store doing for you for Westside overall?
Westside we've been reporting consistently that it's been contributing about 4 to 5% of our revenues on a quarterly basis. And online continues to be a very important channel to deliver convenience to our customers. Right. It is not about being transactional, so we are not really interested in discount promos, offers, coupons, that kind of push to sell. It is about convenience, and to that extent, to the customer who resonates with the Westside offer, all that Shailina talked about, we want to be able to say, listen, we are available online. Right. And in doing that, we again differentiated because we don't do any marketplaces. Again, a choice, matter of discipline. We do it only through westside.com or our app or on Tata Click. So we're just essentially listing on our own platforms.
But I would add to that as a brand, the aspiration of the online shop is as beautiful, is as considered, is as special as walking in a store. And the ease of shopping and the convenience. So we bring fashion to life with photography and with a vibe online. And I think we want to be an omni business where a customer can just transition from online to store and just resonate and connect with Westside at every level.
Is the Westside brand going to be the online amongst the universe of brands that you have under Trend?
Oh, absolutely. I guess Westside is going to be the brand which is going to be online. Right. And it is a choice that's for the brand that we have made, and we will stay with it, Shilpa.
Fair enough. You spoke about the expansion of Westside also. Sort of brings me to the question, will you look at the overseas markets also for Westside eventually? Is that something that you would like to do for Westside?
We're very committed to India, Shilpa, at this moment in time. And India is a very interesting market and has a lot of growth opportunity. That said, I don't think so there is anything which stops us from exploring it in due course.
Right, a rare conversation with the management of Trent, which will be a nifty entrant come September 30th. And the management quite gung-ho on the possibilities of Westside. The street quite gung-ho on the possibilities of Zudio itself. The stock up 0.75%, but that's just about today. Look at it over the last many years and you'd see the kind of wealth creator that this one has been. Take a short break. Come back. On the other side, we have Manisha Gupta, as always, joining in with all things commodities. Stay tuned.
right, welcome back. This market, of course, doing a little bit of a down move, nothing major at all. 50-odd points down, 25,337, which is, by the way, around the last all-time high. Yesterday, of course, we made a fresh one. What's top of mind as far as commodities go? Manisha is here with that. Manisha, morning.
Thank you for that, Prashant. Well, top of mind is absolutely gold. I could do a bit of a song and dance on that. The way the markets have moved on to this one, 2% of gains in the overnight markets, and we're trading above $25-60 an ounce. Well, that is what the gold prices have done, actually. It's traded 4% up in the last 1 month, 34% up when you look at as compared to in last 12 months. And for the year, we are up 22% as well. So it has been good going. And the important point is that this gold prices are gaining, even as various other asset classes also seem to be surging higher. Well, when you look at the way the prices have moved, this is also coming on the back of ECB cutting interest rates by 25 basis points yesterday. This has been a second time. The last time ECB cut rates was the month of June. So July, nothing happened. August, none as well. And then we've seen happen in September. The markets also are looking at the US Fed rate cut estimates for the next week. 25 basis points is now an 87% probability and a 13% chance of a 50 basis point rate cut as well. But the markets clearly are reacting to the US unemployment data, which has seen a rise. The overall inflation seems to have eased, so the market's clearly reacting to that as well. And it is not just the US Fed meeting. You have Bank of England and Bank of Japan monetary policy meetings as well in the next week. And then the buying has been very strong from investors, HNIs, hedge funds, money managers. Net longs now stand at a 5-year highs. So that tells you the kind of interest the markets have on gold right now. Well, also all the profit taking, all the corrections that we've seen in case of gold have been very shallow, and gold has seen buying on every dip in the last couple of years or so. This is what we've done in sense of prices in this year itself. So the low was at 1992, and from those kind of levels, and this was the kind of level that we saw in the month of Feb. Since then, we've seen prices continue to gain up, trading at 25.60 right now. The year started with 2058. So from those kind of levels as well, we are more than $500 up for the year for the gold prices. Now, going forward as well, the expectation is that you could be looking at higher highs from here. This is the gold outlook forecast that I've collated from various reports there. Citi believes 2,500 of an average for this year. Wisdom Tree talks about 2,585. JP Morgan also believes that 2,500 of an average is where the gold prices will be for the fourth quarter as well. And then you have Bank of America talking about 3,000. This is for 2025. Goldman Sachs talks about 2,700 as well, and this is for next year as well. And you also have similar kind of reports coming in from various other parties which are talking about levels of anywhere between 2,700. That is what Metal Focus tells us. So 2,700 to 3,000 really seems to be the range for the next year. And most of these banks and brokerages also believe that not just 2024, but 25, 26, and until 2027, they are quite bullish.
All right, Manisha, thank you very much for that. Well, let's take a quick commercial break here. We're going to come back with our segment. It's the economy. Lata will get chatting with two big bank treasury heads, Neeraj Gambhir of Axis Bank and B. Prasanna of ICICI Bank, for some money market talk. Stay with us.
The crash in crude prices and in many global goods prices due to Chinese exports, Reserve Bank's new liquidity rules requiring higher purchase of bonds, India's bond index inclusion, are all very positive news for Indian bonds. So where are bond yields headed? Is 6% yield possible sometime in 2025? Likewise, given the dollar flows and the falling inflation rate differential between India and US, can the rupee appreciate over the next 12 months? These are the two seminal questions we are asking managers of two of the largest bank treasuries in India, B. Prasanna of ICICI Bank and Neeraj Gambhir of Axis Bank. Gentlemen, good morning and thank you very much for your time. These are very, very crucial questions. Prasanna, first, let me get the immediate out of the way. Yesterday's CPI number coming in a little higher than expected. We were building to some kind of a RBI softness expectation, bond yields going to 6.8. All that out of the way, is it a status quo or are you still expecting dovishness?
So, Lata, I think, yesterday's CPI inflation was a little disappointing. I mean, had it come to where we were all expecting, it would have been much better and the narrative would have been solidified. But at the same time, I also think that we never expected RBI to change stance very soon in October. And we were of the view that the earliest they would probably do is probably a change in stance in December, followed by a rate cut in February. So to that extent, I don't really think that it changes the narrative from our side, because if you really look at the overall, the fundamental factors that are driving our expectations from where it is, most of it seems to be in place with a very favorable global backdrop, oil coming down, expected inflation coming down, and goods inflation, like you spoke about with the Chinese growth where it is. So I think the narrative is building up. Maybe it is now slows down a little bit and some kind of a reality check that maybe not in October. But I must say that markets were anyway not factoring in a rate cut in October. I mean, it's more like a more dovish talk, which I still feel is kind of possible.
Oh, still kind of possible. Okay, that's important. Neeraj, what would be your spin in the near term? There was a lot of expectation, at least I heard in the market, that a softness of the Reserve Bank in October itself is possible, partly because of the debate stirred by the chief economic advisor questioning inflation targeting. And then, of course, good monsoon, crude crashing below $70. So are you expecting an earlier softness from the Reserve Bank than you thought before? Like probably December rate cut?
I think December rate cut looks a bit too aggressive call at this point in time. I think a change of stance in December is something which can be thought of, provided the inflation data in September, October and November is on the softer side than expected. The underlying inflation trend continues to be very soft. Core inflation is soft. I think what is spoiling the party is the vegetable prices. So if we see over the next 3 months that overall inflation, headline inflation numbers are somewhat softer than what RBI has forecasted, I think there is a possibility that we might see a change in the stance in the month of December. I'm not expecting a rate cut as yet. I think we still are in a situation where the headline inflation is quite above the target and is not expected to get to the target, at least in this financial year. Growth continues to hold up well, even though there is some softness that is creeping in. So all in all, I think still not at a stage where we can start calling out for rate cuts. But yeah, some change in the tone and tenor of the language can be expected in December.
Okay, let me move from RBI rate cuts to the market yield, which is a different story altogether. RBI has not done anything by way of rate cuts, but yields have fallen from almost 7.2 to 6.8. Of course, they've changed their liquidity. Prasanna, what's your sense in terms of yields? I'm asking you for the better part of 2025, calendar 2025. Your bond inclusion, LCR purchases, all that will start. And the estimate of LCR purchase also I would want from you. And therefore, what happens to bond yields?
So I think, Lata, beyond what we think the RBI is doing, like you rightly said, the market has gone ahead with a lot of other expectations. And if you really look at the number of factors that are responsible for this favorable outlook on bonds, first is the global backdrop, which is clearly getting more and more dovish as we head towards the Fed policy. In fact, today morning, there was an article in the WSJ, which is kind of indicating that even now it is quite possible that the Fed might do 50 basis points. So those kind of, I mean, it's pretty clear that the Fed chair is favoring 50, but then he has to take the committee with him. And so it's a close call between 25 and 50. So that's one. Second thing is the fact that the Q2 inflation is also going to be 30 to 40 basis points lower than RBI's estimate. The third is the fact that our external situation, the CAD and the BOP, which was anyway already looking quite positive, now got a little bit more positive because of the fact that oil prices have been coming down. And like you rightly pointed out, liquidity, which is one of the reasons why it was kind of creating a roadblock for bonds to rally the early part of the year. RBI has consciously been letting more money into the system. The government is also consciously, I think, running down its WMA balances, which is one of the reasons why liquidity was tight, either by way of more spending or by way of reducing their borrowing. And then finally, the demand-supply balance, which is like you again said about the LCR, the FPI buying, and all the financial savings which is flowing into long-term funds. So I think all in all, it is a quite favorable environment for bond markets. And that is one of the reasons why we have seen the yields fall down. And as we go towards the calendar year end, I would see a slow grind lower. I wouldn't say something like 6% is possible, but obviously something like a 6.65 kind of a level is definitely possible as we go towards
25%. In 25, do we see 6?
Oh, in calendar year 25. No, even then, Lata, I think you need to have a view of repo rate at 5.5 if you have to believe 6% on the 10-year is possible. So I still feel, we feel that our base case is for a 6% repo, in which case you can justify a 6-quarter 2-year yield and a 6.5 kind of a 10-year yield. But 575 has opened up, so it's in a probability right now. But I think we need, like Neeraj said, we need more data in the next 2 or 3 months for us to, solidify that view that a larger rate cut is possible in this.
Okay, a quicker answer from you, Neeraj. Where do you see the 10-year in 2025? I heard 6. That's why I'm asking you.
Yeah, I'll be much more briefer than Prasanna because he's covered everything. I'll say that for me, it's difficult to think about anything lesser than 6.5 at this point in time. For 2025, because unless and until we have a clear view around rate cuts in the calendar 2025, I think it's difficult to imagine a 10-year bond yield lower than repo rate plus some spread. At the moment, repo rate is 6.5. If you imagine that maybe 25 to 50 basis point rate cuts likely, then maybe 6.5 is where the market would anchor 10-year at this point in time. And this is a slightly longer-term view, subject to all the caveats about data and a whole lot of other things falling in place.
Okay. So a 575 repo can mean a 6% bond, 10-year bond, because right now, look at the difference. It is 6.5 repo and 6.8 10-year. There's only 30 basis. So if the demand keeps...
If I may comment on that, I think the behavior of the yield curve in terms of its shape is very different at different stages of the cycle. Yeah. We are currently at the beginning of a potential rate cutting cycle, and therefore the yield curve is flat. But as you get through a few rate cuts, the curve may not stay as flat and some steepness would be required to creep in.
It's maybe a little more, I completely take your point, but there's also the juncture that India is in terms of index inclusion, in terms of the narrowing differentials, which brings me to the rupee, Prasanna. Is there a gentle appreciation possible? We saw it once in 2008, if you remember. We came all the way from 45 to even 39 to the dollar. By the time the fund flows were all in, and then of course the crash started. Do you think a year of appreciation is possible, 2025?
I think, Lata, the best person to answer this question is obviously going to be the governor and the Reserve Bank of India, because they are the biggest, that's one part. But if you have to look at just the market forces, I would tend to agree that with interest rates falling in the US, this time around, I definitely think that it's going to help emerging market currencies with FPI flows, equity and debt flowing more into emerging markets. And hence, India will also get the benefit of that. And in addition to that, like I was briefly pointing out about the macros, with most of the macros being where it is very positive, I think you can make a case for an appreciating, INR. But considering that we seem to, the fact that RBI is quite aggressive in building up reserves whenever there are inflows. And, of course, intervening on the other side when there is depreciating pressure as well. But since they have been very aggressive in building up reserves, I also feel that what is happening to the yuan and what's happening to the other competing currencies from a trade perspective is something that the RBI will have a close watch on. And just to close the argument, I would say that even if the rupee were to depreciate, I think it will depreciate far lesser than what is priced into the forward market, which itself you can consider is something like an appreciation bias. So it's not that the spot rupee will have to appreciate, but even if it doesn't depreciate as much as what the interest rate differential warrants, that itself is something like an appreciation for the rupee.
You answered the question I was going to ask you, that, is the depreciation going to be far lower compared to the year that was and compared to last historical averages? Neeraj, a similar question. Actually, KV Kamath yesterday made a strong argument that rupee is on the cusp of appreciation. He compared India to the similar position that China was and Japan was in their own periods of explosive growth. But for the RBI, is an appreciation on the cards, Neeraj?
Well, RBI is the most important driver and the factor. So I say, but
macros. I meant macros.
Yeah, but for the RBI is a very hypothetical question. Is it possible? Is it possible? Answer is yes. Yes. Is it probable? I would think no. I would still think that the need to accumulate reserves, the need to build a very strong external war chest, the need to make sure that rupee stays competitive, Mind you that even after all this, the inflation differential between India and the West would be close to 2%, right? So we still need to see a depreciating currency to ensure that our purchasing power and our external competitiveness is maintained. So I do feel that even if the flows turn significantly positive and the current account is very well behaved as it has been, I think the depreciation bias will continue. Obviously, I don't expect the currency to depreciate in a meaningfully large way. I think it'll be about 2 to 2.5% annualized rate of depreciation. That should be good enough for us to actually maintain that level of competitiveness that we need to have. I would also argue that the desire to have a appreciating currency might look good on paper, but actually it's a disinflationary as well as demand destructing sort of story, right? So I think we should anticipate some kind of mild depreciation.
No, I certainly don't want an appreciating rupee, and I'm on RBI's side. But I just want to ask you questions about the market wants. Just 2 words, please, because I'm disobeying my studio director in terms of time. Prasanna, the rupee range and the 10-year lowest yield that you see in FY25. In 2025.
You mean calendar 25?
Yes.
So I think I would put 6 quarter to 6 half, not lower than that for sure.
Okay.
And the rupee range would be 83.75 to 85 kind of levels. 84.75.
Neeraj, same question.
I think 84, 85 on rupee, broadly that range. And 10-year, I see it going, I mean, it's very difficult for me to see it below 6.5 on a sustainable basis at current juncture.
All right. Thank you very much, gentlemen. I overshot time, but thank you very much for your answers. I have to take a break. Chartbusters come.